we are seeing some evidence that the economy is indeed slowing.
The Fed needs to be very, very cautious.
It's been impossible to project anything in this weird environment.
I think the Fed put is back. The economy is going to slow, but I think earnings are going to be resilient.
There's still really a good chance that we're going to see a lot of this volatility.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market on the S&P 500 slightly negative over the last week. Anything but. All about a rally. Tom Keene, 7-day winning streak on the S&P 500, 8 days on the NASDAQ. Over that period on the NASDAQ, we're higher by 8.4%.
It's a character of it. I noticed Microsoft yesterday out to a record high, I believe. Don't quote me on that, John. I was on sabbatical. But the basic idea here is Microsoft with leadership on AI, on tech. Up we go with tech. And, we had some great guests to talk about that, leading with Dean Kernan. But what I would suggest is Ben Laidler there. The bulls were lonely 6 weeks ago.
They're emboldened now.
The bulls were lonely. Pinky Chada was talking to a crowd of one.
I think when the people like Ben Laidler come out and start saying the Fed puts back, I think it's fair to say the bulls are feeling confident, Tom.
Yeah. John Stolfus was on. John Stolfus was like a piñata with a short crew, 6 weeks ago? We're 20 points SPX away from his target.
He's got company, that's for sure. Bramo, we've been asking the same question over the last 24 hours. Is the Fed going to spoil the party? Chairman Powell a little bit later.
They're all trying to, sort of. They're sort of tiptoeing around. Well, we might have to do more. We heard that yesterday from a couple members, including Neil Kashkari. They haven't done enough, and the market isn't listening. And that was the clear takeaway yesterday when the more Fed official came out and said, you know what, we could do more. The market was like, I don't think so. But Chair Powell had a chance to do that last week, and he didn't.
They sound nervous, don't they? Governor Waller turning around and calling the bond market move an earthquake. They're still trying to understand. You heard that a lot in the Fed speak of the last couple of weeks.
Yeah, dark matter is all the things that we don't understand with respect to term premium. This is concerning because when you talk about the stock market rally, you think about what actually happened. All that happened was a rally in the bond market. This is not a stock-driven story. So at a certain point, no one seems to understand the move in the bond market, and no one can get very much conviction.
I think it's a stock-driven story. I'm with Ben Laidler on this. There's some earnings veracity to what's going on. Maybe on the revenue side, and maybe nominal GDP will come down and revenues will be a little lighter here. But let's remember that 6 weeks ago, 8 weeks ago, the street was extra gloomy. And that's when you move. And, John, that's the persistency we've seen here.
I disagree with you both.
That's great.
Just to get the show started.
Yeah, okay. Well,
equity futures on the S&P, totally unchanged. What a run it's been in this equity market on the S&P 500 and the NASDAQ. The longest daily winning streaks in 2 years on the S&P 500. In the bond market, yields a little bit higher, up by 3 basis points. Lots of supply that Lisa can run you through in just a moment. Your 10-year Bramo, 459.36.
Yeah, we will get to that supply in just a second. You're talking about the Fed speak, and we're going to hear from Chair Powell, which is going to be basically a footnote because he's giving the introductory remarks at the Fed's Centennial Division of Research and Statistics Conference. He's going to also be speaking alongside Vice Chair for Supervision, Michael Barr. The lineup of Fed officials coming out every week, every day to speak is just getting longer and longer. We're also going to be hearing from Fed Vice Chair Philip Jefferson, Philadelphia Fed President Patrick Harker, and Michael Barr, Vice Chair for Supervision, all ahead of this, which to me, John, you are right to point to as possibly the key event of the day at a time where we do not understand what has been really whipsawing 10-year Treasury yields. We are going to get an auction, the first of real duration. The Treasury is selling $40 billion of 10-year notes today at 1 p.m. Do we see people come out? We did see people yesterday with a 3-year note. 10-year notes are different, though, and this, to me, is a huge test.
10-year, then 30-year. This piece of Bloomberg analysis in the last 24 hours, I strongly encourage you all to read. The estimated annualized interest payments on U.S. government debt has climbed past $1 trillion at the end of last month. Bramo, that's doubled in something like 19 months. It's unreal.
And you talk about why do people care? When are people going to wake up and start saying, how many bonds are the U.S. government going to sell? It starts now, given how much borrowing costs are rising.
Waiting for the White House press secretary, TK, just to open up the daily news briefing.
Yeah, Bramo, I
Quote
could
the
see
10-year.
doing that. It'd be great. She could do the 10-year.
Bramo's going to do it for the White House.
Bramo can be White House press secretary. It'll be great. Olivier Blanchard published yesterday. It was a redo of my book of the summer, his magisterial book on the linkage of all this blather with our fiscal policy. And Blanchard's summary is simple. It's so screwed up, Europe more than us, that we're going to extend the x-axis out, and he used the dreaded D word, decade. This is a decade solution.
The other thing that's getting expensive are all the streaming networks that you're going to be buying, and that's been something that's been a theme throughout the year with all the price increases. We get more of that today with earnings from Warner Brothers before the bell. We get AMC after the bell with a real discussion around the Taylor Swift effect and how long that can last.
She's
and then
of
Disney.
The top 10 singles.
I know.
She's like the Beatles in 1964.
Oh.
But to me, I think you just absolutely crushed John.
What? No.
She has 7 of the top 10 singles.
Okay.
And Disney, too, is reporting.
All right. Cool. Great. Can we get to Dean? Let's do that. I think Dean Kernet joins us now, founder and CEO of Macro Risk Advisors. Taylor Swift better than the... No, just no. Let's talk about this rally. Rent it, don't own it. Dean, what does that mean?
Yeah, well, I guess Taylor Swift's equivalent in the stock market is the Magnificent Seven in the NASDAQ and the Triple Q. So a couple things happened last week that are pretty profound, and I just want to run with something Lisa said, which is the stock market rallied because the bond market rallied. And that's just not typical. There's been a reordering of the cause and effect, right? The history of duration as a stabilizer in a portfolio is that when the stock market gets into trouble and there's a nasty move lower in risk assets, the bond market rallies. So the bond market is a recipient of a flight to safety. Here, the bond market in some ways is the risk asset, and the stock market is secondary. And set against the fiscal backdrop, I think it's altogether dangerous. I'm not inspired by the fiscal dynamics. You mentioned numbers like $1 trillion in interest expense, and that's only going up from here. So that's a risk. But in the near term, the short term, we have a reprieve. And, we talk a lot about long and variable lags with respect to monetary policy. No one really knows what the impetus is for inflation going up or down. There's a lot of theories, but they're long and variable, these lags. With regard to financial conditions, that channel is short and precise. And all of these metrics that define financial conditions, they're all going the same way. So I'll give you an example. Interest rates come down a lot last week, so do credit spreads. That's also atypical. Those are goosing, financial conditions. In some ways, it's good for the stock market short term. It's good for risk appetite. But it might complicate the Fed's process for trying to rein in inflation to the extent that inflation is a function of asset prices. They're all very correlated in a lot of ways.
Any reason to believe those correlations break the other way anytime soon?
I would have said that they would have by now. In other words, I would say that up at 5% on the short rate and a 5% 2-year note, you can argue that duration is going to play that role of stabilizer, that in a risk off, you're going to see a rally in the bond market. I do think that's going to return. Ultimately, we're going to see, and this is what we ended our conversation last time, Jonathan, with when I was on the program, was 2-year notes, great place to hide out. Right, I felt good to be alongside Stanley Druckenmiller in that context. I think you've got a lot of ways to win. You're getting paid to wait. And you're getting paid a reasonable amount above inflation. But I think ultimately the response mechanism for yields, and I would put the back end in a little bit of a different category because of supply and because, frankly, of fiscal irresponsibility. But something like the 2 to 5 year part of the curve, that's a nice place to hold some capital because I do think ultimately you'll rally on a risk off.
I got 3 standard deviations down to S&P 4,100 where we were a cup of coffee ago. We've come back halfway. We're barely back to halfway in terms of the volatility matrix out there. But within this, we're doing it in quiet. The quiet that's out there, which you highlight in your research note, is extraordinary. Does that mean a more short squeeze to come if we drive higher?
I would say not really. I don't think the market's super under-positioned, and I would say that implied volatility reflects that. Typically when you have a big short base, you might have something that indicates that the market's susceptible to a big pop higher. You can look underneath the surface of the implied volatility in options, and you can see that there's not this expectation of a large jump. Jonathan, you started with rent versus own. So, in U.S. housing, renting is historically cheap versus buying. We know affordability metrics in housing are awful, just given prices and rates, that combination. In markets, the buy versus rent trade-off is also very favorable to the renter. And I like to call the option buyer a renter. I like to say that the renter doesn't pay for the plumbing problem. And so in markets, there are a lot of potential hiccups that can come. set against the VIX here that's down at 14. And I'd also point to a NASDAQ VIX that's at 18. That's really low. So you've got, for example, in the NASDAQ, a 30% move up in the stock market, in the market this year, and a really cheap cost of renting the market out to year end, set against pretty favorable seasonals as well. So I really like buying upside calls in either the S&P or the NASDAQ.
You said earlier the bond market is the risk asset, and this is highly unusual since this is usually the ballast. Does that mean that people are overly sanguine to the riskiness of stocks, or that stocks have gotten underpriced because people are so confused by the stabilizer being so volatile?
I mean, I think we can look at the stock market valuation metrics in a number of different ways. Versus earnings, you're kind of middle of the road in terms of PE multiples. Some might argue that your multiple rate adjusted is too high. And so as rates have come up, the multiple hasn't really suffered to the extent that people have thought it would. But ultimately, earnings are solid and stable. And I think as I step back and we go back to this term long and variable, I just don't think we've seen the impact of rates just yet. I think it's a 2024, maybe even to 2025 story. So I think the quiet in the market is a reflection of stability in the multiple and stability in profits. Ultimately, I think that gets dented, but it's a ways away.
In the next couple of days, we're going to have to start worrying about a government shutdown again, and I'm sure that we're going to hear a lot more, especially after the Republican primary debate later today. How do politics figure in, if at all, into what you're seeing in terms of volatility or how you're positioning?
Yeah, so shutdowns are not debt ceiling, date certain, you've got to get this done by a period of time. I do think the shutdown is just another indication of the fiscal issues on the left and the right and the inability to govern in a lot of ways. You know, the Fitch downgrade, I think, late summer was a function of not just the debt dynamics, but also just the ability to work proactively and effectively on behalf of the country. So I think it's just going to be another notch in this inability to work together set against just awful fiscal dynamics that aren't going away.
Dean, this was great. Really thoughtful stuff.
Thank you.
I'll go home later and re-listen to it all. Dean Kernan there of Macro Risk Advisors with some really important stuff there on the bond market. If we can get to crude, just get up the market board quickly and take a look at WTI. WTI crude is trading in the 70s. We're down again on a session. We just had the biggest one-day move lower in about a month yesterday in the oil market. 76.84 is the lowest since July. So here we are, Tom, in the 70s on WTI crude on the same day that Israel said its troops have entered the middle of Gaza's main city. This is not where we thought we'd be a month ago.
Yeah, it's without question the great missed call here. I missed it as well. I was wrong on this, like everybody else. I don't know if 90 or 100 makes sense, but certainly to see 70 is a shock. And what I saw in my sabbatical that was so important, I'll be publishing on this, folks, a sabbatical. You'll look for that paper in January. But on the lengthy sabbatical I took, John, I would really suggest the whispers of deflation out there. Just to give you one idea to link into $70 West. What are you laughing at? West Texas Intermediate.
The sabbatical paper.
What I would
just the idea that people are going to start Googling for this paper that's never come out.
But within all the gloom that's out there and all this, how many Fed speakers do we have today?
A lot.
A lot. That's 8 too many. A lot. Guess what? Pork prices in China have collapsed. That's another example of a global deflation. Look at the different vectors of Germany. Another example of disinflation and deflation that's out there, and you see that within the shock of oil.
Is the price story getting better because the supply side's improving, or is demand rolling over? When it comes to crude, we're going to be talking more about demand, I think, Lisa, in the weeks to come.
Especially because the U.S. government put out a report yesterday saying that American gasoline demand will drop to a 20-year low next year. So just put that into some of the reasons that might be backing some of the move that we've seen.
Brent, 81, WTI in the 70s. Dean, good to catch up, as always. Next hour, Sebastian Page at T. Rowe Price is going to be joining us on this programme to break down a stunning rally. In the equity market, 7 days of gains on the S&P 500. Have we opened the door for a rally into year-end? From New York City this morning, good morning.
I think that the House Republicans and the Senate in general are committed to the government not shutting down. For many reasons, I don't think it will. Or if it does, it'll, shut down for 8 hours or something like that. There is a commitment from both sides, from Speaker Johnson and from the Senate, not to have a government shutdown. How that works out, I can't tell you, but I do think that's a commitment.
It's a commitment. Senator Bill Cassidy of Louisiana speaking to our colleagues on Balance of Power in the last 24 hours. We need to talk about the next 24 hours. The amount of debt coming to market from the US Treasury. Lisa went through the 10-year notes that come a little bit later on this afternoon. $40 billion worth. Then on to tomorrow, $24 billion of 30-year notes. You put it all together. The interest cost in this country right now, this is coming from Bloomberg Analysis here in New York. The estimated annualized interest payments on the US government debt pile climbing past $1 trillion at the end of last month. Bramo, these are interest payments. I think we have to keep going back to that. We're talking about interest payments through $1 trillion potentially.
The deficit is manageable when interest rates are near zero. If you're not paying anything on this debt, you can have a massive debt pile. When interest rates start climbing, that same deficit becomes punitive to the level of 5, 6, 7, 8% of the GDP coming out 10, 20, 30 years. And this is what people are focused on. And people in Washington, I guess, have to realize this might be what's going on in the bond market.
It's a real world, and I take your point strongly that it's going to be a political football. I'm not saying people will vote on the debt or the deficit, but it's going to be discussed here as we see this higher interest rate. But I would run it up against the arch formula, R minus G, and that all of our interest rate analysis is predicated on America having buoyant growth. And that's a little bit shaky right now. That confidence is not quite
We
there.
certainly got that in 3Q. I think now we're looking for that to slow into 4Q and into next year as well. If you are just joining us, here are the scores in the bond market. The 10-year right now, yields aren't in the 5s anymore. That's the good news. Over the last couple of weeks, we're back down to the 4s, 458.73. We're up a couple of basis points on a session, though. In the equity market, what a run we've seen. 7 days of gains on the S&P 500, 8 days on the NASDAQ 100.
Let's review this. This is important.
Can you call it a melt-up, TK?
No, it's not a melt-up. It's a persistent bid. I've been watching it really carefully. I'm away. I'm on the sabbatical. We're trying to decide when to publish. And the answer is I'm watching this on an hourly basis. And the bid's there. It's not about a melt-up. It's this kind of thing. Pulls back. In they come. Pulls back. It's a different feeling now, as Dean Kernet talked about.
The longest run of gains, Tom, in about 2 years, going back to November 2021. Up by more than 8% in a week on the NASDAQ 100. It's quite a run.
VIX 14.86 right now. Let's get to the political moment here. Look for Balance of Power tonight. Anne-Marie Horton and Joe Matthew on that. Jeanette Lowe joins now, Director of Policy Research at Strategas. It is a Baird company. Jeanette, these elections matter to me. And when I look at the governor of Kentucky, when he won Attorney General, he won by 2,000 votes in Kentucky. When he won the first time as governor, he won by all of 6,000 votes. There is the shock of Virginia. Was it a question of close votes, or did the Democrats win resoundingly?
Well, I think the Democrats had a really strong night last night. I think that in a lot of these cases, as you mentioned, Beshear in Kentucky won by only 0.4 percentage points in 2019. This time he has about a 6 percentage point lead going into his reelection. Yeah. So that is a strong validation for him being popular in the state, the Democrats being able to campaign on the correct issues this cycle. We saw that, Democrats did have momentum going into these midterm elections or off-year elections. They had won 24 of 30 special elections over the course of the year. And then last night with the elections that you saw in Kentucky, in Virginia, in New Jersey, in Pennsylvania, you showed that Democrats really did have some momentum on these down ballot races.
To borrow from the former president, so much losing. Will the Republicans change their approach?
I think that one thing is going to be difficult is that the one issue that has continued to be quite salient for the Democrats is the abortion issue. They used it in 2022. They used it this year. It's been a very good driving issue. You saw turnout in a number of these races, particularly the Ohio abortion measure that drove the election results. And so that is something that Democrats are going to be continuing to look forward to in 2024. You already had Sherrod Brown, who's up for re-election in Ohio, noting that he's probably going to be focusing on abortion in that race as well. And in Virginia, the Republicans tried to change the narrative a little bit on abortion. They tried to talk about a 15-week ban and said it was more of a limitation. It was more reasonable than what the Democrats are proposing, and voters rejected it. And so that is going to be very instructive going into 2024. Republicans are going to be struggling on this issue. They're going to have to figure out other issues that would be better positioned in order to get some votes and change some of these outcomes.
Jeanette, how do you understand the fact that Biden is losing in a lot of polls, particularly with the matchup with former President Trump, and yet the Democrats had a really good night last night?
So what it shows to us is that Biden is weak, but it's more isolated to him. And so down ballot Democrats have been able to separate themselves. They've been able to show their own messages. And that's important in a lot of these races. And it's very important going into 2024. Now, obviously, having Biden at the top of the ticket will be important. We do still have a long way to go. Polls at this point are not necessarily very instructive to what we're going to see in November 2024. But it does show Democrats that they have an opportunity to separate themselves from Biden, to still go out on their own messaging and still be able to produce strong results. And I think that should give the party a little bit more comfort this morning as they're looking ahead to 2024.
It's coming amid a lot of discomfort, I should say, especially after the censure last night in Congress of Michigan Democrat Rashida Tlaib. This question around the fissures in the Democratic Party, do you think that they have been overplayed or underplayed heading into this election cycle?
So, I mean, this is going to be something that's going to continue to ramp up, this issue, particularly with the, support for the Middle East and how this gets done, whether we're trying to just support Israel or are we trying to really help Palestinians in Gaza. That's going to be an issue. But I think you also saw that in a lot of these races, it goes down to specific issues within that district. And people were thinking about whether New Jersey, whether Senator Menendez's indictment would have a negative impact on Democrats in that state. And it didn't. So a lot of these races, they are local. It's more focused on local issues. And so when we go into 2024, national issues will matter more. But I think you can see that Democrats are also able to reach their base. Right. And then it's going to be up to Republicans to also have a similar counter message.
Jenna, not to get the crystal ball out, but we do have a surveillance crystal ball out today. It's right here. It's putting off a nice glow here. On radio, it's a beautiful crystal ball we've got in front of us. Jeanette, I'm going to cut to the chase. The Republicans have to adapt. That's all there is to it. In the primaries, in the debates as well. What nuances will we see? What does a Haley do? What does a DeSantis do, et cetera?
Well, so I think one of the things that we'll be watching for tonight is, Nikki Haley has been getting some momentum, and now we have a lot of geopolitical issues that are at the surface. And so Nikki Haley is going to really try to capitalize on those issues and try to put herself above Ron DeSantis in that frame. So that's something where I think we're going to be really watching, because as we've seen over the past couple of months, that geopolitical issues are becoming increasingly important. Bread and butter issues are always going to be important in a presidential race, but these issues are going to be important going into 2024. We probably haven't even seen the extent of it yet. So the dynamic between someone who's very strong on national security versus someone who's stronger on domestic issues, I think that's going to be a big play in the debate tonight.
Jeanette Lowe, wonderful to get your thoughts as always. Jeanette Lowe there of Strategas, the third debate, I believe, for the presidential candidates for the Republican Party. A headline crossing the Bloomberg just moments ago. Let me share that headline with you. This is from the executive arm of the European Union, the European Commission, formally recommending opening membership talks with Ukraine. Several layers to this that are worth working through. The Commission's opinion needs to be approved by EU leaders at a summit that will take place next month, so in December. Alberto Nardelli here at Bloomberg does a wonderful job at breaking this down, so I suggest you go out there and read the story that he's just published. But Tom, ultimately, this can take a long, long time. So the last member of EU expansion was Croatia. That took 10 years. And if Ukraine wants to make this happen, they're going to have to go through a series of reforms. And Alberto lists some of them, and I can share some of them with you right now. They need to enact legislation on minorities, anti-corruption, to regulate lobbying, to bring it in line with European standards as part of this anti-oligarch push. Tom, this can take a long time.
It's going to take a long time. It's going to be step by step. But can you imagine the reaction at the Kremlin today?
So those kind of headlines,
stunning.
This is the direction of travel. Let's put it that way. Coming up, Nick Benenbrook of Wells Fargo from New York City. This is Bloomberg. 7-day winning streak on the S&P 500. What a run. Best run of the year so far. In fact, you have to go back 2 years for a run better than this one on the S&P. Likewise on the NASDAQ, futures look like this, just about unchanged on the S&P 500. On the NASDAQ 100, unchanged as well. On the NASDAQ, though, over the previous 8 days of gains, we're talking about a gain of 8.4%. Led by tech, obviously, helped by this in the bond market, 2-year, 10-year, 30-year. The high of the cycle of the year on a 2-year was 525, call it 526. That was the middle of October. Go back to the high on a 10-year, that was just north of 5%. And these are the levels we've come back to. 493 on a 2-year, on a 10-year, back to about 457. And Tom, that move has supported this equity market.
It has. There's no question about it. The bonds are linked into the equities as well, but there's something else going on. There's again, when you look at the equity bid that's out there, and I'm going to just go out, John, to the wall of money that's out there and how many people were on the sidelines, that's overlaid into the bond rally we've seen.
The trillions of dollars in money market funds. Lisa, sitting there. Rick Reeder of BlackRock started to talk about this on Friday, and I started to think about it over the weekend. What would it take to unlock all that cash to get people to start distributing it back, allocating it to the equity market again?
You know what I saw recently? A lot of people talking about dividends and saying, well, how much are these companies actually paying out? And the fact that they're doing that makes me think it might take a while. Because right now, if you're keeping your money in cash, you're getting a 5% yield. If you're looking at stocks as a dividend play again, they have a long way with earnings per share as well as with the actual dividend payments to catch up with where bonds are.
You want to talk about the surprise of the last month? I keep going back to the same place. It's in the commodity market. It's crude. We've just had the biggest one-day loss on crude going back to the start of October. We're in the 70s on WTI.
Look at follow through.
The lowest since July, Tom. The lowest since July, even with the heightened tensions in the Middle East.
No, this is the global demand story. It's just all there is to it. And we're going to talk. We've got a wonderful guest coming up, John, to really nail this down.
Let's start there. Under surveillance this morning, Israel is saying its troops have entered the, quote, heart of Gaza City as it continues its operation against Hamas. Prime Minister Benjamin Netanyahu saying there'd be no ceasefire until the roughly 240 hostages are freed. G7 foreign ministers releasing a joint statement calling for humanitarian pauses in the conflict. Biden urging Netanyahu to agree to a 3-day pause, according to Axios. Tom, Lisa and I were talking about this yesterday. The pressure that's ramping up on this president here in America to ramp up the pressure on the leadership in Israel to conduct some kind of what they're calling humanitarian pauses is just getting higher and higher.
It's like every other war, except this is the first war with this immediacy. It's amazing to line up 6 newspapers, 6 websites, and see the immediacy of the transfer of information. It's just... This is absolutely original.
And I think a lot of leaders are trying to figure out how to work with that because that flow of information is very much affecting some of the protests to the people who are coming out. So you have leaders like Saudi Arabia coming out and saying, hey, Biden, hey, Israel, we have a problem because our people are getting outraged and we are running out of time, even though Saudi Arabia hasn't taken the idea of normalizing relations with Israel completely off the table.
By no means am I an expert at this, but the animosity, I'll call it, of the various Arab League nations against select parts of the Palestine community is evident. I mean, that's one of the complexities beneath the headlines.
That pressure is domestic as well, Tom.
Yeah.
Could well become a campaign issue going into next year as well, an election issue. Speaking of elections, local elections. Virginia Democrats winning majorities in the state's 2 legislative chambers, ending Governor Glenn Youngkin's efforts to unify GOP control in the state and dealing a blow to his possible presidential bid. This was one of the number of wins for Democrats as voters in Ohio endorsed abortion protections, while the Democratic governor of Kentucky also won re-election. Bramo, we were talking about Governor Youngkin jumping in. Governor Youngkin himself wasn't talking about that, but ultimately you'd have to say, at least this morning, off the table.
So 2 things. Does this take Glenn Youngkin off the table, not only for this cycle, but also for 2028, right? That's number 1. And number 2, does that put Nikki Haley very much in the front-runner seat to possibly counter the former President Trump? And the debate that we get tonight at 8 p.m. in Miami might shed some light on that at a time when maybe the election results that we got last night are not indicative as much of the national mood.
But off the radar, does a 45-year-old in Kentucky join the Democratic debate for 2024? Maybe not. I believe we have a sitting president. but 2028, and this is Governor Bashar winning nicely in Kentucky, a lonely Democrat.
We do have a sitting president, but we're still talking about the prospect of that sitting president dropping out of the race for a second term. That conversation's going nowhere. This story caught my eye this morning. Chinese President Xi Jinping set to be the guest of honor at a dinner with U.S. business executives when he visits San Francisco for the APEC summit next week. Bloomberg reporting hundreds of people will be in attendance at the dinner, including CEOs of major U.S. companies. While China is yet to confirm Xi's attendance at APEC, the White House has already said the Chinese leader will meet with President Biden at the summit. I just want to try and frame this. I cannot think of a bigger spread between the mood of the country, the position of Congress, and then corporate America, which is somewhere over here when it comes to relations with China.
Yeah, I don't disagree at all. Just in the last 48 hours, we've had CEOs wandering off to the Asian Rim to keep the dialogue going. Are they our diplomats? That's a debatable question.
They're their own diplomats, and they're all their own diplomats. And here's my question. How much does Xi Jinping need them? And how much can he actually promise them stability at a time where the rules are changing and there isn't necessarily some concrete feel that they're not going to be upended with something, right? How much is this him courting them rather than them courting him? It is a two-way street at a time where that economy is seeing a decline in foreign direct investment for the first time ever in data going back decades.
I think you might be able to go a little bit further. I think some people might describe some of these business executives as diplomats for China and not diplomats for what's happening in the United States of America.
Well, I think that some people would
push back. And I stress some people.
Yes.
I'm not suggesting that, TK, you want to save this?
I'm going to save it right now. Everybody listen, and particularly Global Wall Street, listen right now. He is too modest to mention it. There's a single line in his biography at Wells Fargo of a tour of duty at Brown Brothers Harriman. He won Currency Forecaster of the Year 2 years in a row. That is unheard of. Nick Benenberg joins us now, international economist at Wells Fargo. Thunderstruck. I got all sorts of currency questions, but we don't have time for that. You have a single sentence in your report of global GDP of 2.4%. In my textbook, that's a recession. Are we in a global economic recession?
No, I don't think it's the recession. It's a downturn. It's a slowdown. But actually, I think one of the previous times I spoke to you, I was mentioning 1.6%. So I've actually gotten a little more optimistic, Tom. It's going to be slower, but I don't think we're about to go into global recession.
Okay, it's 2.4% is not a global recession, but the IMF has it out to 2028. Do you see where this works out, and with your expertise from New Zealand, that it works out across the Pacific Rim to a new buoyancy? Do you have a recovery in mind?
We do, although to be fair, I think when we look at sort of long-term trends, we're probably thinking about 3% global GDP growth as opposed to 3.5%. And I think one of the reasons for that is China, for example. There's been a lot of policy stimulus this year. They still have demographic issues. They still have property issues. And so I think we need to become accustomed to a slower trend for the Chinese economy and so a slower trend for global growth overall, even beyond this downturn that we're going through.
Before we move on, just to have you weigh in a little bit on the discussion we were having of Xi Jinping meeting with hundreds of business executives in the U.S. in San Francisco at the meeting coming later this month, do you think that this is China realizing that it's losing foreigners, it's losing the room, and it needs those businesses to not see even slower growth and a more difficult situation?
I think that's probably correct. I mean, obviously, I wouldn't want to speak for the Chinese government or try and understand their motivations. But what we're seeing, for example, is greater fragmentation across the global economy and some of those trade linkages, starting to fragment. And also, I think that there's some hesitation in terms of just the large-scale domestic stimulus or fiscal stimulus in China itself. And so if you can sort of utilize the global market to a more of an extent, I think that's a way to address the slowdown that's taking place.
There's been a lot of debate around the oil price that we've seen, and we were talking about this earlier, that prices have fallen even though everyone expected them to rise in the face of geopolitical uncertainty. Is this a demand story that people are underappreciating that suggests some sort of slowdown on a global level that has not been fully priced in?
I think that's probably true. Certainly, the slowdown is taking place here in the United States, but it's a gradual affair. It's, 150,000 in the payrolls last month. But when we look around the global economy in Europe, we think UK is probably going to fall into recession, and Eurozone, if anything, will just narrowly avoid it. You really have to look far and wide to see areas where there's a lot of positivity. And so, yes, I think that 2.4% that Tom cited, that slowdown's coming through, and so in that sense, it's understandable that we're seeing this decline in oil and commodity
I
prices.
can't fathom the value add at Wells Fargo having you as an international economist with your foreign exchange team, which is also noted as well. What is the Wells Fargo call? What is the Benenbrook call on dollar resiliency?
Well, for now, we think, as I mentioned, that slowdown's taking place, but it's really hitting hard in Europe right now. And even Canada, for example, we're seeing a downturn in businesses there as well. So, I think that downturn's going to come a little later in the United States. In terms of relative performance, the US does well for a little while. The dollar, I think, can gain against the euro, against the pound, and against the Canadian dollar, probably 2%, 3%, 4% through until the early to middle part of 2024.
Neil Kashkari, the Minneapolis Fed president, was on yesterday, and he's watching the dollar as well. And he said the reason why he rejects ideas that the yield on U.S. Treasuries in the long end have risen as fast as they have is because of the fiscal picture. He said the reason why that's not really what's going on is because take a look at the dollar. The dollar should be weak. Do you buy that argument, or do you think that on a relative sphere, all developed markets are facing the same problem, which is interest payments going up and deficits that are not going down?
I mean, I do think most governments are facing, challenges now in terms of, elevated debt levels. Japan's a notable example, and they're clearly dealing with their exit from yield curve control. So yeah, I think it's an issue that's pretty fair across most countries. Also, I would suspect that these debt issues, they do come slowly. As we heard before, the voters aren't going to vote on debt or the deficit itself. So for right now, in terms of the day-to-day on the in terms of the day-to-day of the foreign exchange market, we're probably looking at relative growth as opposed to that longer-term deficit issue.
We've got to look at the math, and of course, with Nick Benenbrook, you've always got to look for the probabilities. John, we've got to go to Professor Winchester at the Auckland University of Technology, who is the world's expert on rugby probabilities.
Oh,
and
here we
this
go.
guy
Okay.
nailed.
Now I know
this
where we're
guy
going.
nailed that the All Blacks finally, without Dan Carter, would be at risk, and that's what you and I observed the other day with Nick Benenbrook.
Nick, would you like a word on your World Cup loss in the last couple of weekends?
I think the less said the better, but thank you for mentioning that, Tom.
TK, why did you go there?
I want to go there because I thoroughly enjoyed it, and I had no clue what I was watching. Should they have beaten South Africa?
I feel like that's every segment, Bramo, isn't it?
Yeah, it is true.
It was fantastic. I just had no clue.
Were you watching this incredible match in France and the emotion of it, knowing that they should have beat South Africa?
Maybe I can come on again in 4 years' time when the next final is on. But it was a lot of fun, and it was a great.
To be as dominant as they were for most of the final, Tom, one man down through most of the game. It was pretty incredible. And you mentioned Dan Carter. For people who don't know, Dan Carter was basically the greatest fly half ever. He used to play for New Zealand. He was the guy that took the kicks. And I would say the All Blacks missed, was it 2 kicks? 2 kicks in that game?
They did. I remember those. I remember both of those misses. Yes, I do.
I think
if Dan Carter was there, you'd have to imagine at least one of them go in, and then it's a different result.
Should he ever retire? He's 41 years old. Did he have to retire?
Maybe I can get out there and have a kick. I might have done it just as well.
Okay.
Phenomenal effort. Good to see you, Nick. Thank you, sir. Nick Benenbrook there of Wells Fargo. Squeezing in some rugby here, TK.
Well,
nice.
Guy Johnson
would be so
called
proud.
me up, and Guy just said, you've got to talk to Benenbrook about, New Zealand and the All Blacks. They never lost when I was younger. Like, they literally never
One thing
lost.
that stands out for me, and I know you and I talked about this a little bit earlier this week, the respect that rugby players have for match officials, for the referees, is phenomenal.
Out
They
of
make a
control
decision.
in the Premier League.
They make a decision. That's the decision. You walk away. There's hardly any back chat. Maybe the captain goes over and has a conversation. There's full transparency. That's it. And they make mistakes. Mistakes, but still, you walk away. European international football right now, Tom, club level football, particularly in the Premier League, is absolutely dreadful.
It's out of control.
The attitude to the referees, I would go with you. It's out of control. It's not good.
It was good to see AC Milan take
Win
the
a game
trophy last night against PSG, because I didn't see much back talk against the refs. It was different than the Premier
We
League.
actually won a game, Tom. That was nice.
Yes, it was nice.
Thanks for that.
Game.
Thanks for tuning in. Dan Ives of Wedbush coming up shortly on this massive tech rally.
Today.
Why Dan Ives thinks this rally can continue after a big move over the last week. From New York City this morning, good morning.
we look at the broader tech complex, we do think that the outlook has improved, even though we do remain, neutral on the sector. We do think that there are pockets of opportunities. We do think that the growth complex still remains intact, even though you might have some outliers in some of the larger names, like particularly in the smartphone and hardware area.
Nadia Lovell of UBS on the latest equity market move, the latest equity market call over at UBS. I have to say this morning, was going through the Southside research. I was so happy to see Jonathan Goller, Patrick Palfrey publishing for UBS over from Credit Suisse, Tom. Just fantastic to see.
It's a big deal.
I'll share some of the research with you. It's worth a read. This is their view now. Expect the S&P 500 to end 2024 around 4,600, implying an upside of only about 5% from here into year end. They're seeing weaker growth hurting revenues. Tom, that's the call from the team over at UBS at the moment.
Well, that's a call, what they're looking at here. But I just think there's a lot of ambivalence in this quarter, and the guidance forward is as mysterious as the economic growth. Who's got a Q1, Q2 view?
It's got a 24 view.
What do you write in your outlook after being that, all of us, including me, that wrong 13 months ago?
Those outlooks need to be published in the next couple of weeks, and I think that's going to be tremendously difficult to stick by those calls deep into next year. The call from UBS here, Bramo, sticky wages, deteriorating pricing power, rising interest expenses, ultimately weighing on earnings going into year end and beyond.
Yeah, although one area has been immune to anything weighing on earnings, and that's been the tech story, and not just any tech. And this is really my question. How much is the success of some of the biggest tech behemoths at the expense of some of the other tech companies? And I think about startups and smaller tier companies that don't have the economies of scale.
They also say a steep acceleration in tech earnings. So worth pointing out that bullet point in the note, Tom, contributing 2 to 3% to S&P 500 earnings next year.
We'll have to see. With a VIX at 14.84, that is Dan Ives' market. He is senior equity research analyst at Wedbush. He refuses to talk to us when Apple earnings come out. We only get him to pick up the debris. And we can tell, for those of you on radio, you can understand he's long Lily Pulitzer as well this morning. Great look, Dan. I want to talk about your 240 call on Apple. You're not lonely. There's a few other people out there with Dan Ives' optimism on Apple. When I saw those margins in a company managing for profit, not revenue growth, can you raise your 240 estimate?
Yeah, look, I think this is just the beginning of the next phase of the Apple story. You look at margins that are historical. You look what's happening on services now, mid-teen growth, and iPhones, despite the haters continuing to hate, is growing. Even when you take out currency and you look, it's even growing more. ASPs, the China iPhone demise story is a fictional Netflix story. And in my opinion, this is just the start of what I ultimately view as a $3.5 to $4 trillion market.
It's a slow day. We got to make some news here. Can you pop from 240 up to 250 this morning for us?
Look, I believe I believe the best case or the bull case is probably closer to 275 as this all plays out. Because also now you don't have AI in those numbers. This is just the get out the popcorn moment for when Apple ultimately, I believe, over the next year introduces the AI App Store. And that's just going to be, ultimately from a services perspective, that could be an incremental 5, 10, 15 billion a year.
You made a couple of statements, so let's drill down on them. We can do that. We're friends. You talked about growth of the iPhone. What growth are you talking about?
So if you look at unit growth, units are growing into the December quarter. You also, if you take out currency, which is a headwind, you have basically mid-single-digit growth.
7%.
7%.
But you've been talking about a massive boom of people upgrading. I guess my question to you, Dan, to be polite about it, have you been right for the wrong reasons on the stock?
Sure.
Would you acknowledge that?
I would say that ultimately, if you look at this, what I view as a mini super cycle, that's playing out. The ASP stories played out. And I think our biggest call has been China. Despite many yelling fire in a crowded theater, the China growth is actually increasing, not decreasing.
But they had a down quarter, right, in China?
Well, if you look at China, mainland China was actually a record for the September quarter. When you look at the overall, as Keene talks about the initial reaction after, iPads, Macs, that and $3 get you a cup of coffee. I'm focused on iPhones where units were up in China.
What I'm struggling with, though, and you'll appreciate this, if you came on today and say margins are better, they are. I'm with you. Okay, margins are great. Service revenue is where the growth is. That deserves a higher multiple. I understand that. maybe you can make the case for why the stock is higher this year based on those things. When you say things like iPhone super cycles, when we've had no growth for 4 quarters in the company, that's where I struggle. Can you help me understand that?
So let's dissect that a little. First, when you think about the, call it 500-600 bips FX headwinds, that is actually underlying growth that you're seeing in iPhone units, just to steady state it. I also believe our whole view of the iPhone cycle is really going to be over the next 3, 4, 5 quarters. That's where you're going to have these upgrades that actually come through. I'm not saying that you don't have some maybe minor share losses on the sort of mid-tier, but in terms of high end, as a utility, this essentially is going to be a mid to high single-digit growth on iPhone. And when you start to run that through, that could be an incremental $1, $2, $3 of earnings as you look out the next 2-3 years.
There's a lot of growth already baked into valuation, and a big piece of valuation is where the buyers are going to come from. And you've been traveling around the world trying to hold everyone's hand and convince them that there is still value in big tech. How much do the losses of other areas of the tech-like sphere, and I'm thinking of Masayoshi Son and the more than $11 billion loss on WeWork, how much does that play into a little ambivalence about buying the story right now?
Look, I think you're definitely having winners and losers in terms of this just broader economy. And I think in terms of the Magnificent Seven, in terms of big tech, I think the strong get stronger. But Lisa, to my point, being in Asia for a few weeks and in Europe, it's very easy to sit there here in New York on your 10th floor spreadsheet being negative on Apple. What I see out in the world is a much different environment in terms of the growth that's happening. And I believe tech, to your point, you're going to see the strong continuing to dominate. And I think in terms of AI, we are just in the early stages of monetization. I think that's a big thing in this tech bull market. Microsoft saw it in terms of AI. You're starting to now see monetization. Datadog, that's a Hall of Fame quarter in terms of what we saw there. Palantir, the Messi of AI. And I believe ultimately right now, the AI gold rush is actually starting.
That sounds lovely on that side. On the side of how much we're paying for price monetization and monetization of AI, I'm looking at Apple Plus in sort of the amount that's increased. Are we going to be paying $600 a month to Apple for all of our various services?
Look, I think over the next...
we already are.
That's my point.
But to your point, I think over the next year or two, I think the average Apple user is going to start to definitely increase what they're paying Apple on the services, because ultimately, as it goes out, the AI technology that's going to be in fitness, health, in the App Store, that's just going to give them just another added growth to the monetization of Cupertino. And I think part of why the stocks reacted, despite, many, I think, being very negative initially, as it's come through, to Ferro's point, iPhone, you're now starting to see grow. Services, mid-teen growth. Margins, this is just another, flex the muscles moment. And I think that's on a sum of the parts, how this is a stock that ultimately is going to be a $4 trillion market cap by 2025.
Just picking up on Palantir, the Messi of AI. Why are they the Messi of AI?
Because I believe they are the purest play AI name in the market, period. And look, Palantir is one where, many have been negative on that story for a number of different reasons. But I think what you're seeing now happen is that they've actually parlayed enterprise success, and you're now seeing the use cases explode. I believe Palantir in 25 is our base case, but that is the golden child of AI.
I got to make some news. Any day now, do I see another massive mega billion-dollar Apple debt offering?
Look, I think that's something that, clearly, could be on the table. I think the bigger thing for Apple is I think they're finally going to look at M&A, and we've talked about.
Come on. We got to extend the interview. They're going to buy Disney by the end of the week?
I believe ESPN is the asset that ultimately they'll buy.
Okay. You got a number for that?
I think 35 to 40 billion.
Like real money.
In terms of what?
Not a Beats transaction.
But it not Beats $3.5 billion. But also it goes back to the MLS deal. That was, I think, where the light bulb went off in terms of live streaming sports. I think ESPN's a unique asset. And look, right now, you look at the top of this mountain. It's Nadella. It's Cook. You're really starting to see ultimately more of an opportunity where they could go on the offensive rather than defensive.
Okay. Dan, it's good to see you. It's
Great to be here.
Thank you, buddy.
Thank you.
Dan Ives of Wedbush on tech. Equities right now on the S&P just about unchanged, happening right now at the New Economy Forum that Bloomberg is hosting. Our editor-in-chief, John Micklethwaite, in conversation with the Prime Minister of Singapore. You can watch that on Bloomberg at LiveGo.
We are seeing some evidence that the economy is indeed slowing.
The Fed needs to be very, very cautious.
It's been impossible to project anything in this weird environment.
I think the Fed put is back. The economy is going to slow, but I think earnings are going to be resilient.
There's still really a good chance that we're going to see a lot of this volatility.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
I might leave this show. I'm getting so much abuse in the commercial breaks. The Christmas tree is going up.
Quality abuse.
Next weekend.
Okay.
Next weekend. So the weekend before Thanksgiving, Bramo.
Okay.
That
just
works. That's a good thing.
Country Living says no, but the Family Handyman says it's okay to even leave it up all year round.
Country Living's the Bible, is it?
Well, I don't know. I mean, it depends on, who you are.
Festive.
Okay.
It's festive. Get into the season. You play a bit of Mariah. It's a good thing. From New York City this morning.
I'm so staying.
Good morning. For our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market's unchanged on the S&P 500. We're looking potentially at an 8th day of gains on the S&P 500. Day 7 yesterday. We've had 8 days on the Nasdaq 100. We've been talking about this rally now all week, Tom. It's a move of more than 8% on the Nasdaq over the last week.
Tangible move for the bulls. It's off the October lows set. What was it, a year ago? We're looking back 13 months now to, the Ralph Van Kamper, Ed Yardeni low. Other people were on board there as well. And this is how bull markets extend. And what's fascinating, John, to see is that we've done this without catharsis. We didn't get a VIX out to 30. We didn't get a VIX out to 35 or 40. I got a VIX all the way deep into 22. So it's really interesting to see this lift up, but without that emotion where people climb on board.
We've talked about a pushback in the last 24 hours from Marko Klanovic over at JP Morgan. He's talking about the growth policy mix not looking good into year end. Mike Wilson of Morgan Stanley, I think, might describe this as a bear market rally. Bramo, to hear Ben Laidler of eToro say things like the Fed put is back. I've got no idea if the Fed puts back. I can give you plenty of reasons why it might not be. But ultimately, is that a sign of how quickly sentiment has turned or what? To hear that kind of language on this program.
It's giving some life to this hope, this dream on Wall Street that the Fed is going to come in with significant rate cuts next year. And that will turbocharge a rally without the weakness subsequently in the economy. That, to me, is the takeaway. There is a big divide between those who see the bond rally as a positive for risk assets because it's maybe a right sizing and a devolatilization. I just made up that word.
Nice.
It's great.
It's really good.
Keep it up.
CFA level 4 right there.
I'm just wondering at what point people are going to worry about why yields are going down.
What was the word again?
It's really good. Devolatilization.
Love that.
Thanks.
Love that. Coming to a south side note near you in the next couple of days.
Absolutely not.
Here's your equity market, just slightly negative then on the S&P 500, pulling back a touch. Yields a little bit higher by a single basis point on a 10-year, 457.91. Lisa's going to run through all the Fed speak we get today and through this week. And Lisa, also all the debt issuance that we get through the next 24 hours.
Yeah, we're going to be getting, I believe, $64 billion over the next 24 hours in terms of 10 and 30-year notes. Today, the Fed speak does include Chair Powell, although don't expect him to actually say anything because it's only preparatory remarks. New York Fed President John Williams, Vice Chair for Supervision Michael Barr, Fed Vice Chair Philip Jefferson, and Philadelphia Fed President Patrick Harker, just a few to come out and try to push back on this recent rally and be ignored by markets.
No, I don't agree. Michael Barr is different. He's separate and different. As vice chairman, Michael Barr is really, John, going to be important on the regional banks. This is in the zeitgeist right now.
Yeah.
Are they going to change the rules? I don't even understand what they're going to change. But this is everybody in banking, commercial banking, is going to listen to the Barr speech.
We embrace division of labor and Ricardo's comparative advantage on this program, don't we? Because you just don't read the Fed speak at all.
I couldn't believe what Ricardo did. I mean, look, in Brazil, when Ricardo went into the pit, that was just not the time to do it.
Okay, we'll leave that there,
Meanwhile,
TK. Get to the supply, Bramo.
Let's get to supply, and I'm sure that Tom will find something to disagree with me on this one, too. U.S. Treasury is planning to auction $40 billion of 10-year notes today, coming after yesterday's 3-year auction, which came out pretty solidly. Tomorrow, we have, I believe, $24 billion of 30-year notes. This is the key test. Are markets truly sort of benumbed to the idea of supply, or have they been calmed down by the fact that the Treasury Department did not sell debt in greater volumes on the long end? To me, this is going to be really important. Tom, do you agree?
No, but it's great because when Lisa gets going like this, what time of day is this? When is
it's 1 p.m.
1 p.m. I got to get up from the surveillance. You get this going. This is the
All right,
Bramo
let's
thing.
move on. Entertainment earnings weekend. Warner Brothers before the bell any minute now. AMC Entertainment and Disney after the bell. And I'm really just watching. Yes, we want to hear about Taylor Swift and how many costumes she changed in and out of and then won billions of dollars into her paycheck. But there is a question to me. How much are they going to jack up the streaming on Disney, on Warner Brothers, on all of them more than they already have this year?
It's an interesting question, actually. I mean, it's like $5 here, $10 here, and it adds all of a sudden it's like real money.
Those numbers just crossed on a Bloomberg. We'll bring those numbers to you in just a moment. A bit of feedback. I was cool with Ferro putting up the tree before the pilgrims showed up. Continues. But there is no reason, capitalized. Mariah should be played before December 1. I always took you for an intellectual Ferro and then just shamed. Shame. Do you want me to hold back on Mariah?
I'm holding back on this.
Shame.
Yeah.
Shame. With us around the table, Sebastian Page, Head of Global Multi-Asset and CIO at T. Rowe Price. Seb, good morning to you.
Good morning.
Constructive equities, you've been buying stocks. That's a change for you. Why?
Yeah, I've been saying I was reluctantly bearish for parts of the year. October 27th, market was down 10%. Sentiment and positioning, according to our indicators, was down 1 standard deviation. We decided to buy stocks, and we have a lot of portfolios. We closed a 75 basis points underweight position, but that was $3 billion worth of buying, and we were done by Monday. The timing looks great in hindsight. I got to clarify, we're asset allocators. We look out 6 to 18 months.
Right.
But when it comes to execution, we can be pretty dynamic. And Tom, you had asked me before on the show, what would bring you back to neutral between stocks and bonds? And I'd said, I need stocks to come down, and I need the VIX to come up. The VIX actually was only at 21, 22, but overall sentiment and positioning was depressed enough for us to go back to neutral.
This is a really, really important conversation, folks. And what's so important here is Sebastian Page is living in your world. It's about asset allocation. His book is absolutely definitive. This is the adult read on asset allocation beyond diversification. And I'm going right to where Bramo is, which is your chapter, Momentum and the Study of Horoscopes. You're out there saying it's about horoscopes and, you know, whatever that is, momentum and something about horoscopes. That's the way the Gloom Crew looks at this market right now.
Well, macro momentum has been negative, and momentum traders, momentum investors tend to look short-term. They tend to look at patterns. And you know what? There is academic evidence that if you look 3-4 weeks out, there is something to momentum. But on the other side of that, you have value-based investors that take a longer time horizon. And Tom, that's what makes markets. Now, I'm learning a new term today, devolatilization.
Thank you.
That is, you know, that is the debate right now. Rates have been so volatile, so incredibly volatile. And if that calms down, I think there's upward pressure on rates, but nonetheless, that's been the risk driver.
I'm begging the next time you have a T. Rowe Price board meeting that you use the word devolatilization and, you know.
Just for the record, a viewer writes in on Twitter, on X, that actually is a word that I didn't make it up, devolatilization. So I'm just throwing that out there. It means something completely different from what I'm actually talking about, but it doesn't matter. I really want to lean into when the moon rises over Saturn, given the horoscopes that we're talking about. When can bonds be the stabilizer again? Dean Kernet was talking about them being the risk asset. You're basically pushing back, saying that isn't going to be the case for much longer. Are we going back to 60-40?
There are two ways to look at bonds and the stock-bond correlation. I've studied this over years, going back to the 70s, and the 70s provide an interesting analogy to right now, in some ways, not in all ways, but in ways where you see stocks and bonds go down together because of a rate shock. It's very ultimately simple. Are we looking at growth volatility, recession risk, in which case bonds, treasuries should be your stabilizer in the portfolio? Or are we looking at inflation volatility and rates uncertainty, in which case, yes, stocks and bonds will be positively correlated. Going back to tactical, we're still short duration in our portfolio under the hood. We're positioned in what I call the magic barbell. We're actually long credit and long cash at the same time. That, to me, speaks to our view that we're not going to devolatilization so quickly, that there is volatility and possibly upward pressure on rates where we sit right now.
So does that mean that stocks are the new stabilizers, that basically, based on what we just heard from Dan Ives, go buy Apple, go buy Microsoft, and then have cash?
I think that narrative is overdone. At some point, post-COVID, people were describing those big large cap tech stocks as bond proxies. Mm-hmm. That's not the case. Those are stocks. You sit lower in the capital structure, and stocks are volatile, but that's why you get paid for holding stocks over the long run. So I don't necessarily buy into that narrative that stocks are the new, or in particular, the Magnificent Seven are the new safe assets.
Can you take a long-term view on financials when I don't seem to know what drives them right now? It feels like they're stuck between a rock and a hard place. I had this conversation with Laurie Calvasina of RBC yesterday. Yields were up and that hurt them. But then if yields drop because growth is doing poorly, then that should hurt them too. What helps them right now?
Earnings, ultimately, and if we've bought them in earnings. And let's take a step back. Growth keeps surprising on the upside, and that might continue. We started the year, the consensus GDP, John, was basically 0%. We're looking at 2.3% real GDP for the year. Q3, at the beginning of Q3, the consensus forecast was 0.5% of real GDP growth. We just printed 4.9%.
That's amazing.
So growth continues to surprise on the upside. This is more specific to the U.S., and you got to balance this. So you might ask me, why are you not actually overweighting stocks? Why are you just neutral?
Why aren't you overweight stocks? Why aren't you neutral?
Thank you, Jonathan.
No worries.
You have to worry about the long and variable lags. And, I'm a huge fan of the show. You've been talking about narrative roulette.
I'm glad someone is.
Thank you. You've been talking about narrative roulette on the show, right? The narrative changes every single week. And the best example of that is that we had one non-farm payroll at 150K that was slightly below. We had a slight Fed comment.
Goldilocks
and
is
all
back.
of a sudden, we're the narrative is different.
Goldilocks is back and Sebastian's buying stocks.
Yeah.
Just like that. Things have changed.
There you go.
So it's good to see you, as
Thank
always.
you.
Sebastian Page there of T. Rowe Price. Do you want some numbers from Warner Brothers? Revenue, 9.98 billion. The estimate, 9.98 billion. Barbie was the highest grossing film in Warner's history. Do you know what's lost so far this year in the movie business? Everyone knows it's Barbie. Do you know what was number 2?
The Oppenheimer?
Super Mario Brothers. And
Really?
it was number 1. Super Mario Brothers was number 1 before Barbie came along. Super Mario Brothers generated $1.36 billion in global ticket sales.
It seems like you're the demographic.
I watched that movie.
You did?
I watched that movie.
With who?
At home on my own.
Jesus,
because of nostalgia of the N64. The Nintendo 64 in the
Oh,
90s.
yeah.
And a computer game. And that's why I watched it. Yeah, right.
Yeah.
See? That's
like
why I
the
watched
mushroom
that.
and it gets all big.
If you watch that movie,
Yeah.
you'll feel the same way. And Nintendo, the reason I bring this up overnight is because they're going to do a movie with Legends of Zelda, aren't they?
And they're doing very well because of it.
So there you go.
I see
There
those
you
shares
go. That's
pop.
the movie knowledge, Tom, and the stock story and
barely
financial
keep up with
markets. If you're just joining us, stick with us. There's more to come. In your equity market right now, we're negative 0.02%. In the bond market, Tom, yields a little bit higher by a couple of basis points.
Yeah.
58.53. I'm with Lisa. You've got a test on a 10-year today. Bit of supply. I say a bit of supply. A lot of supply coming from the Treasury today and tomorrow. 10-year today, Tom. 30-year tomorrow.
Well, perhaps confidence building. What I would note about the entertainment business in this WBD is they are 61% debt versus an Apple. I mean, you know, how does Dan Ives say they're going to go buy something? Apple's not debt encumbered. They have massive free cash flow, and people like WBD, they're the other side of the story.
I'm just curious about how long nostalgia is going to work. Nostalgia for Barbies, nostalgia for Super Mario Brothers. This is basically what's fueling profits. It's our all desire to go back to our youth.
Nostalgia for who? This is the important point. Nostalgia for millennials.
Yes, correct.
Because that's where the money is right now.
Exactly.
That's the important point here.
So what other nostalgia
Super
items
Mario
can we
Brothers,
bring
Legend of
out?
Zelda. I think Usher's doing a Super Bowl.
I actually asked my kids.
You see?
I said,
no
have
idea.
you ever heard of who this is?
No idea.
Who?
No idea. That's when you know you've got old, Bramo.
I knew I got old a long time ago.
You're the target audience and the kids have got no idea what's going on. Peter Cheer, next hour on Bloomberg. I'm putting myself in the same bucket with you, Bramo. Same generation. Equity futures on the S&P 500. Unchanged.
I think that the House Republicans and the Senate in general are committed to the government not shutting down. For many reasons, I don't think it will. Or if it does, it'll shut down for 8 hours or something like that. There is a commitment from both sides, from Speaker Johnson and from the Senate, not to have a government shutdown. How that works out, I can't tell you, but I do think that's a commitment.
It's a commitment. The words of Senator Bill Cassidy of Louisiana speaking with our colleagues on Balance of Power. We'll catch up with Anne-Marie in just a moment. If you are just joining us, here's your equity market picture. The story of the last week, really. Gains, gains, gains. After the last 7 days, 8 days actually, on the NASDAQ, we've had a move of 8.4% on the NASDAQ 100, 8.4% higher. On the S&P 500, 7-day winning streak on the S&P, the longest going back 2 years. So slightly negative today, Tom, on futures, but ultimately over the last week,
where's the effervescence?
Much higher.
14.8, well, there it is, 14.80 on the VIX. Where's the effervescence? To me, it's just a bid. It's just money coming in. I don't see an enthusiasm. I just see relentless money coming in.
We were spooked by this move in the bond market. Governor Waller of the Federal Reserve calling it
kind
of
I
earthquake.
noticed that. Yeah.
I think moving down from 5 to the 450s on a 10-year, people taking some comfort from that. Question we've asked, though, Lisa, over the last 24 hours, are we confusing a rally with stability? Is this real stability that we're starting to see in the bond market?
It's a great question.
Or is it just a repeat of what we've seen over the last couple of weeks in the other direction?
I actually think that's the reason why the auctions are so important to watch, and that's why Tom is going to be tracking them, because what I am looking at is the potential for maybe more distaste for how much debt is coming to the market. If you get that today at 1 or tomorrow at 1 with the 10 and 20, 30-year auctions, that could change the picture.
10-year right now about 460, Tom. 30-year, let's call it 473. Okay. Backing away from the highs of the last couple of weeks.
Backing away from the highs. The 30-year bank rate mortgage has gone from an 8.03, 8.05 into 7.83. And that's where the behavior pattern changes. So when yields come in here to your auction, do people say grab it now? I mean, that's the arch decision.
In all seriousness, though, you speak to consumer behavior. Does a move from 8 to 7 make a difference on mortgages?
No, I don't think so.
For me, I don't think that moves it
to me, it's how much buyable house can you buy, and it doesn't change that.
It's a fiction because nobody's actually borrowing it. Did you see the mortgage numbers in the New York Fed survey that came out yesterday, and how much the debt has actually declined because nobody's taking out mortgage debt? Why would they, given that they're paying, 8%?
I'm just reading our emails, some devolatilization.
How's that working
It's going great. It's kind of
Everyone's saying it's a word.
We'll get to that in a moment. Right now, we're going to go down to the volatile nature of Washington. Anne-Marie Horton picks up off election details. Our Bloomberg electoral correspondent. Anne-Marie, open question. Which of these many off-year elections got your attention?
Virginia was definitely the most important one, not just because of how close it is to Washington, D.C. Many felt potentially this could be a referendum on President Joe Biden, and given the fact that we have seen him struggle in the polls, but also for the fact that Glenn Youngkin really was trying so hard, spent a ton of money, spent a ton of personal time and capital to try to flip Virginia so that both the state legislature, both chambers, the House of Delegates and the Senate, were red. Mm-hmm. And actually what he has now is a very divided government with Democrats controlling both of those. And the reason why this was so important is because donors were hoping he'd potentially be a last-minute addition for 2024.
Right.
I think the fact that Virginia didn't go fully red, you can park that. But also, what does this mean? He's now a lame duck governor. What does this mean for his remaining 2 years? And then is he going to mull a 2028 bid?
Right. What is the question here about anecdote or fact that the Trump people don't show up if Trump isn't part of the election?
Well, I'm not sure if the Trump people didn't show up. You have to look at some of these races in Kentucky, in Ohio as well, that it was very specific for individuals or measures that they were voting for. What was clear last night, whether or not Trump voters showed up or not, what was clear last night is that abortion is still a key issue for voters. And these aren't just Democrat voters, these are independents as well. So for Democrats looking at November of 2024, they are going to spend heavily, they're going to campaign heavily on abortion. You can see some of the change of tone when they talk about abortion. They're now talking about as a freedom, a right. And this is what the president said yesterday when he released a statement that he was so happy to see in these election results that Americans once again came out to protect their freedoms. This is how they're trying to shape the discussion when they talk about abortion.
The confusion that I have right now is that people say that the social issues matter until they don't, then it's all about the economy. And everyone's been saying that. Last night, social issues arguably won Democrats the election in a number of different places. Heading into next year, is it going to be the economy or is it going to be some of these issues? I mentioned abortion. I also mentioned the Hamas-Israel war.
I think first we still have to remember we are a year's way out. This was a great election for the Democrats. It follows on, President Biden once again bucking historical trends when it came to the midterm election, when everyone thought we would see a red wave. But the fact of the matter is you can have these two truths, which is you can have these off-year elections that did well for the Democrats, but polls again still show that by and large the economy does matter for individuals, and also that they do still think that President Biden is too old. So I still think we are far way off from next year to see what is really going to be a massive driver. A lot can happen in the next year. But to your point, Lisa, about the Israel-Hamas war, most Americans vote on domestic policy. So unless something happens and this conflict spreads throughout the region, has massive impacts, likely this will just be something that happened last year that potentially is still ongoing, and it's a conflict the administration is dealing with. But Americans are going to vote on things that matter to them in their everyday lives.
Let's talk about the domestic issue that we've been talking about all day, that no one maybe will vote on the interest payments of the United States, even though we're going to talk about it every day. Is that true, Anne-Marie, or do you expect more people to start to say, wait a second, the U.S.'s interest payments may double this year to $1 trillion based on how much borrowing costs have risen?
Well, it's certainly a line that Republicans want you to know because they keep talking about reining in fiscal spending, but they also want to cut taxes. Well, to build a budget, you also need to make sure you're raising taxes. I don't think everyday Americans are going to focus on interest payments. I do think everyday Americans, though, are going to look at their own household budgets. How much more are they spending on groceries? How much more are they spending on gasoline? But at the same time, yesterday, it wasn't economics that pushed people into their votes. When you look at what happened in Ohio, when you look at what happened in Kentucky, when you look at what happened in Virginia, a lot of this had to do with Republicans who made it about abortion. Glenn Youngkin talked about a plan for a 15-week abortion ban. Of course, with exceptions. Virginia is 26 at the moment, and that didn't work. And abortion and reproductive rights still matter.
To switch gears, Anne-Marie Horton, what does the Secretary of State do today, given the immediacy of the surrounding of select parts of Gaza City?
Well, he's in the Asia Pacific today. He's going to be talking to a number of allies. Of course, this is right ahead of Biden sitting down most likely next week with Xi Jinping in San Francisco. He went on this frenetic tour yet again to the region. What he is likely doing, and what you see the U.S. administration try to do, is talk about these tactical pauses. They want to be able to make sure they can get humanitarian aid into Gaza, because the humanitarian situation is dire at this moment. We spoke to Cindy McCain today, the head of the World Food Program this week, and she was talking about how food needs to be able to get through, and they'll take anything they can to be able to deliver that aid.
MH, thank you. Anne-Marie, on the latest down in Washington, D.C. The latest in this market at the moment on the S&P 500, just about unchanged. No big moves this morning whatsoever. When you hear Bramo talk really gloomy about markets, Tom, she's trying to cheer herself up. She's got puppy videos.
Hold on a second.
Up on her Bloomberg. Just watching dog videos. I've just watched you do that for the last 30 seconds.
I was watching the dog video, please. Okay, hold up.
Videos.
Okay, full
and
stop.
And forwarding
Pause.
me hate mail from Bloomberg users that read as follows. Putting up the Christmas tree early and watching Super Mario by himself. How many cats does he have? If he has more than 2 cats, he might need a welfare check. 2 things. The wife fell asleep, so technically I wasn't on my own. And the second one, I am not a cat guy. Everyone who knows me knows I'm not a cat guy.
Can I please set the record
straight?
straight?
Do I look like a cat guy?
No, I know you, though, too well. So I think that this is like, but what I'm looking at right now, the videos just pop up. I don't even follow these
you want
accounts.
to excuse yourself from this?
No,
All right,
hold
okay.
on a second.
Well, no, you have some. The floor is yours. You got.
But I will just say this:
20 seconds.
A lot of pet videos in my X feed recently. A lot of them, and I have to say, it's kind of comforting.
I've got Elon's bots popping up in my X feed, and people are going, "Oh, really?"
You're getting comfort from dog videos.
I like them.
Nice.
Yes.
Same. Equities just about unchanged on the S&P 500. Quite a run over the last week. You know the stats by now. 7 days on the S&P. 8 days on the Nasdaq 100. Futures going nowhere on the S&P. Currently on the Nasdaq, we're negative by 0.03%. Small caps really volatile. The Russell this morning down about 1/10%. The rally inspired by the move in the bond market. 2-year, 10-year, 30-year shaping up as follows. Lots of issuance through today, tomorrow. 10-year maturity, 30-year maturity. The 30-year at the moment, Lisa, 471.69. 10-year yield higher by a single basis point, 458.11.
One of the big questions to me is just how many of the institutional buyers that have been sitting on the sidelines waiting for the volatility to die down will come back. And to me, this has been one of the big questions because we haven't understood the move, because we didn't understand how much leverage or hedge funds or just fast traders were behind it. A lot of people were waiting. If they come back today, will that fortify the rally we've seen in the bond market?
$40 billion of 10-year notes a little bit later on this afternoon. On to tomorrow afternoon, $24 billion of 30-year bonds coming to market. So that's stocks and bonds, the relationship between the two. I think it's always really, really hard to make a call on the future and then make another call after that. So let's say you can predict the future perfectly and you can say things are going to happen in the Middle East. Tension's going to boil over. Israel's going to go to war with Hamas. Let's say you saw all those things the week before it happened. Then you made a call in the crude market. Look at crude right now. We've had a big move lower through the month of October.
Wow, down a stick.
We add to it, we're down another $1 on crude this morning, Tom. We're down 1.3%. 76. We're talking about lows we haven't seen since July on WTI.
You know, never pick crude. It's the toughest thing to call. I'm going to go to Javier Blas on that, but to me, it's all about global demand. And I'm going back to Nick Benenbrook of Wells Fargo with a stunning 2.4% global GDP, and he rationalizes out and says it's going to get better. That's the here and now, and the here and now is a global recession if you use what I'm going to call the traditional benchmark 3%.
Start of October, we're focused on supply. Yeah. Here we are in the middle of November. Lisa, I think we're talking more about demand now, less about supply.
Especially as the U.S. government put out a report yesterday saying that American gasoline demand would actually decline quite considerably into next year. So at what point is this a slowdown? At what point is this a switching to other types of fuels? I don't know. It's that dark matter that Neil Kashkari was talking about, but he was talking about it with respect to bond markets.
Confusing at one point that conversation was, I have to say. Brent crude at 80, WTI at 76, under surveillance this morning. Israel saying its troops have entered the middle of Gaza's main city as Prime Minister Benjamin Netanyahu reiterated there'd be no ceasefire until all hostages are released. G7 foreign ministers, Lisa, releasing a joint statement calling for humanitarian pauses in the conflict. Biden urging Netanyahu to agree to a 3-day pause, according to Axios.
It's a horrific conflict, and there's so many civilians caught up in this, and all of us who've been watching the imagery, I'm sure, have this real desire to see it stop, and for a lot of these, particularly children, to have a better situation. The difficulty that we have right now is this question of how to do that, right? Because if Israel says a humanitarian pause will re-embolden Hamas, let them sort of rebuild, the war continues, it could prolong things. This is sort of the question underpinning this, and the immediate scream, to Tom's point, we're all seeing these images. Everyone's just saying, please, make it stop.
It's the speed of it. I mean, I'm not even going to quote the details. I think I know from media reports. It's just they're happening within a 1-hour turnaround. I mean, there's no jokes to be made here. This is absolutely revolutionary, the transfer of information.
I think we're all closely watching, monitoring the approach of this president in the United States. The president publicly standing shoulder to shoulder with Israel, privately, based on reports, Lisa, trying to put pressure on them to conduct some kind of humanitarian pause. Whether the pressure builds to such an extent that he has to do that publicly a whole lot more. That's something I think we need to look out for in the weeks to come.
I think that's a very good point. There are two things here, though. Hamas is looking for some of these images to get out. They have said publicly that they want to have martyrs that can show the world what they're looking for. So you have those images, and then you have certain Western leaders and, frankly, Middle Eastern leaders that are grappling with the emotions and the protests of civilians. So at what point do they have to respond to those in a more material way? We'll
monitor the news, the incoming information as it comes through, and share it with you as we get it. Elsewhere, the third GOP presidential debate tonight at 8 p.m. in Miami. 5 candidates are making the cut. Ron DeSantis, Nikki Haley, Vivek Ramaswamy, Tim Scott, and Chris Christie. Trump, of course, once again, sitting out. Tom, holding a competing rally nearby. So we've got 5 candidates on the stage, the president elsewhere.
Yeah, well, is it a Florida dynamic or a national debate? And I really don't know, because Florida is so damn important. I mean, I would defer to Anne Marie Horton, Joe Matthew, and others, our wonderful Greg Gillespie. Greg Giroux, rather. I just, to me, Florida is different. And it's really cool to have any debate there, Republican or Democrat.
So you know where the polls are, Tom, at the moment for the party. Split down the middle. The former president on the one side, and then 5 on the other.
Yeah.
You know who's got momentum right now? Nikki Haley. Bit of support from Governor Kim Reynolds earlier this week from Iowa for Governor Ron DeSantis. Maybe he can pick up some momentum from there. But ultimately, the clock's ticking here, Lisa.
Yeah.
You'd have to imagine that we have to see more Pences stepping out and more people consolidating around one candidate to take on a former president in the primaries.
And so today, do we start to see some consolidation? Is the pushback going to be more directly at the former president? And is it going to penalize the former president in any way, shape, or form that he keeps not participating in these debates?
I want to finish on this story. We're going to be talking about this for years to come. I think decades. The collapse of this company, WeWork, threatening to upend dozens of leases in cities, including New York and San Francisco. The co-working company, once valued at $47 billion, planning to terminate nearly 70 leases. WeWork's landlords facing pressures from a decline in tenant demand. Tom, it's from $47 billion in private markets in 2019 to bankruptcy 4 years later.
And it's, again, overcome by events. It's not only the stories we know and the failure of management and the failure of this and that, but all of a sudden running into the fact of a commercial real estate implosion. That wasn't in the original calculus about the collapse of this company.
Adam Newman, he won ZERP. That was the headline yesterday, without a doubt. How'd he walk away from this with hundreds and hundreds of millions of dollars? Except didn't just walk. He was almost pushed. He was pushed.
He was pushed at the peak of the market.
Pushed. It's just amazing, Tom. Amazing.
We're going to see right now on the bond market, which itself is amazing and with years of experience. Deborah Cunningham joins us now, Global Liquidity Markets CIO at Federated Hermes. Yield is moving. Will the massive movement into money market funds end, Deborah?
Actually, I think maybe the retail side of it will slow down, Tom, but the institutional side is just getting started. Generally speaking, institutional flows into money market funds stay in the direct market. So in treasuries, in commercial paper, in other types of products that are directly impacted by the Fed's rate changes on an immediate basis. They don't go into money funds, which lag that market, that direct market, until rates peak or plateau, and often start to go down the other side. So I think the institutional trade that spigot will just turn on.
For simple people like me that want a 10-year yield tip point where short-term paper doesn't become attractive, in your head, where does the 10-year yield need to get to before the facts change for the people loving their 5% accounts?
Well, you've got the 10-year now right around the 460, 458. I think that's very much indicative of what the Fed has been telling us, higher for longer. It's also indicative of the most recent Fed speak from Jefferson, from Powell, about the fact that they're still assessing what rate hikes that were done in the summertime, in the spring and the summertime, are having on the economy today, and what the higher bond yields were having. Now, those higher bond yields actually, kind of left the system after last week's Fed meeting, and certainly the payrolls number on Friday. Yet when you really think about it, are those numbers so bad? They're not bad in the context of a continued, slower growth economy. and they continue to indicate that we won't be going into a recession. So, maybe where we are right now at a 458 in the 10-year is a good place for them to be. It's a good place for them to hang out for a while. It still indicates that interest rates aren't going back to something, levels like 0 or 1 or 2%, but they're going to hold, and there needs to be some premium as you go out the yield curve, plus some built-in expectation from an inflationary perspective, whether it's 2 or 3%. The market thinks 3, the Fed wants 2.
Deborah, can you give us a sense of the tipping points where money comes in or out of money market funds? In other words, when yields reach a certain point, people start to say, wait a second, maybe I should take my cash and put it to work in stocks versus it's actually at work in money market funds.
Lisa, I think Bloomberg did a piece maybe a month ago about 5% yields on cash products, on money market type products. With $5.5 trillion to $6 trillion in the market, 5% yields, it's adding 1% to GDP. I think that 5% number to some degree is a tipping point. We're well above that still at this point. But at some point we'll cross down through it. And I think that's a magic number for people. It's meaningful in the context of the economy, and it's meaningful in the context of people's income. So I think that 5% number becomes something where people start to segregate cash again. So cash, we've learned to put into buckets, operating, what would be strategic, and then core. And all of those have been in the money market side for, the better part of a year and a half now. At some point, core will start to peel off, strategic will start to peel off, and operating will remain. And I think, 5% is where that process maybe begins.
So just real quickly here, Deborah, how sticky is the money that has flowed into money markets, arguably away from other asset classes like stocks?
I think you've got a good stickiness of the retail trade. The retail trade was really not coming out of equities or longer term fixed income. It was coming out of deposit products for the most part. You can see as deposit products have gone down by $1 trillion, money funds have gone up by $1 trillion. So that retail trade is about as sticky as it gets. The institutional trade, like I said, that hasn't really even started in force yet, will be the more transitory trade. And we haven't really started to experience that yet. So I think what's in there at the $5.5 to $6 trillion is fairly sticky money at this point.
Deborah, thanks for the update from you and the team. Deborah Cunningham there of Federated Hermes, following a big move in fixed income in the bond market, yields pulling lower, pulling back from the highs we've seen, multi-decade highs in some points on the curve. Chairman Powell's going to speak a couple of times over the next couple of days, Bramo. Are we ignoring today?
Yes.
Opening remarks today and then a bigger one tomorrow, is it?
What's he going to say today? He's going to come out and say, welcome to the conference. I think yields are too low. I mean, honestly, at what point is he going to actually say something that's going to be meaningful when he's introducing a conference on data? He's going to say we're data dependent. It's more than ever important for this to be a data focused Fed.
Tell some jokes.
Tell some jokes. Talk about the weather.
What kind of jokes?
Talk about when he's going to set up his tree.
Do you imagine Chairman Powell humor?
Data dependent. We're on the x-axis.
550 ways to say proceed carefully. Classic. If you're just tuning in, welcome to the programme. Your S&P 500 looks like this. On the S&P, we're positive 0.01%. Yields are up a single basis point, 457.91. I do believe there's a panel tomorrow, right, Bramo?
Yes.
Bit of back and forth, the moderator.
He is going to speak tomorrow, and that people are watching for him possibly saying something. He could say something today. He might surprise us.
The IMF panel, Gita Gopinath, Rogoff, I think, is maybe on board that as well.
What we're looking at right now is the potential for the Fed to try to jawbone the market into less complacency that they're done. However, honestly, Fed Chair Jay Powell had an opportunity to say that there was another hike squarely on the table. He could have leaned into that last week. The fact that he didn't, to me, was arguably one of the biggest generators of some of this rally or stability, as some people would call it, in the bond market.
We got some real movement here right now. I mean, we've got green on the screen. The VIX comes in as well. But, John, to your point on oil, and you nailed this earlier, you were out front of the move that we're seeing now on West Texas Intermediate, decidedly below 78. We're down a solid 1.5%, 76.19. And Euro yen just went out to new yen weakness. And that, was it today Wednesday?
Yeah.
Sabbatical.
It's Wednesday, yeah.
But, on a Wednesday, maybe I'm not worried about euro yen, but going into the weekend with a 161, dare I say 162 euro yen, what will the Japanese institutions do?
I was having one of those weeks where yesterday felt like Wednesday.
Yeah.
The week is long when you're not with me, TK. I miss you.
Oh, please.
It means so much when you're back. It's Friday already. It's a beautiful thing.
It's a beautiful thing. I'm going to tear up. It's emotional. The sabbatical was awesome.
Was it?
It was
Nice.
great. I got below 59th Street.
Oh, what'd you get up to?
Yeah, I got down to like
peeking through the windows at work.
I think the bigger thing for Apple is I think they're finally going to look at M&A. I believe ESPN is the asset that ultimately they'll buy. It goes back to the MLS deal. That was, I think, where the light bulb went off. In terms of live streaming sports, I think ESPN's a unique asset.
Dan Ives, Senior Equity Research Analyst over at Wedbush, thinks Apple might make a play for ESPN. We'll talk about that in a moment. Welcome to the programme. Thanks for being with us. Your equity market right now on the S&P 500, just about unchanged to positive after 7 days of gains. 7-day winning streak on the S&P. Can it become day 8? Already the longest daily winning streak of the year so far for 2023. Yields higher by a single basis point on a 10-year, 4.58, backing away from the multi-year highs we saw a few weeks ago, 3 Mondays ago now, I believe, on a 10-year. That was 5.0187% on a 10-year. We've backed all the way back down. More than 40 basis points that move, Tom, over the last couple of weeks. Your yield this morning, up a single basis point.
The yield movement there is fine, but it's also in credit as well. Lisa, what has spread market shown in this bond rally, price up, yield down? If spreads come in nicely, like
big time.
All's quiet on the Western Front?
Massive rally in spreads, which is the reason why everyone is selling debt right now to lock in the yields. And this is the question. At what point does supply overcome the events of a rally?
Let's take 10 seconds here. Is it almost irresponsible that these mega magnificent 7 don't take on more debt? I mean, they just feel like they're just, everybody else would have a responsible amount of debt. They'd have a bunch of consultants and Wall Street firms say you need 13% debt, 14, whatever.
But if they have all this cash that they can actually earn 5% on, why would anyone say you should issue debt at 7% and pay 7%?
But they're not issuing it at 7%. They're giving it away. I'm looking at a Warner Brothers piece here at 4 3/8 roughly down, but they're not Warner Brothers. I mean, they're issuing debt at what? T-bill rates?
If Apple do come to market, the man himself over at Apple, CFO, very, very good at timing the credit market. So I'd have one eye on that as well.
I would. Okay, well, let's do this right now. In the streaming business, the challenges that we see, Geetha Raghunathan joins us now, U.S. media analyst at Bloomberg Intelligence. Geetha, I looked at the equity space, and with Warner Brothers Discovery, Warner Brothers Digital, whatever it is, they're down. But what I did is I went over, and you can do this on the Bloomberg folks with a DDIS function. I went right over to the bond space, and they're down in the bonds as well. I mean, their short-term paper has gone down 6% in price, given all these challenges. How and when do they recover?
They really shouldn't be down, Tom. I mean, today they posted really good results on a lot of fronts. And so, I mean, the big thing that we're looking for from Warner Brothers Discovery is, good free cash flow. And they kind of stunned there with over $2 billion. We were expecting about 1.7 to 1.8 billion. Adjusted EBITDA, again, came in above estimates. But most importantly, and this is something that we're tracking for all of the media space as they kind of undergo all of these headwinds, we know that their linear TV business is challenged. But what about the streaming businesses? That's something that can, generate sustainable earnings. And, Warner Brothers has been one of the first media companies, apart from Netflix, to show that streaming can, in fact, be profitable. So they lost about $2 billion last year, but so far, year to date, they are actually up and they posted a streaming profit. So, they're doing, obviously, revenue trends are a little choppy. There's no doubt about that, but they're doing everything they can to make sure that the model is sustainable, to kind of future-proof the business. And, I kind of give them full marks when it, comes to results and streaming profits and controlling costs.
And yet the stock is basically where it was about 12 months ago, just looking at the chart here, Geetha. Does Barbie not make a difference to stocks like these? Does it make a difference when you basically produce your biggest movie ever?
It is the biggest movie ever. It's been a total home run for Warner. There's no doubt about it. But unfortunately, there are just too many uncertainties right now, John. I mean, you have the Hollywood strikes that have been dragging on. We've seen kind of the whole film slate. There's just this overhang on the film slate. We don't know when that's, TV and film production is going to resume. We don't know when we're going to get new streaming content, new film content. So there's obviously, a lot of uncertainty there. And so then that kind of raises the question, what happens to the advertising business? So if you look at their TV business, it's obviously kind of in the doldrums. Advertising has been down double digits all through this year. Again, ads were down about 12%. Affiliate fees, which is, dependent on the pay TV universe, again, that was weak as well. So if you're kind of looking at the long-term, a model here, there is a lot of uncertainty still with the TV business. And I think that is what is reflected with the stock and the price today.
Geetha, as you know, after the close, we get the numbers from the Walt Disney Company. Let's talk about that a little bit. Consolidating ownership of Hulu. At the same time, we've got people talking up the sale of ESPN, ABC, almost encouraged by Bob Iger earlier this year. Geetha, what's happening on that front? Who's buying what? Who's selling what?
Yeah, there are just so many moving pieces. Bob Iger obviously is juggling so many balls, and it's going to be interesting. So we know that they're looking to sell, their India business. As you mentioned, they're looking to sell ABC. ESPN again is a big question mark, but I think that they actually want to hold on to ESPN. They're looking for a minority stakeholder, probably from one of the leagues. Ultimately, I think their whole idea of consolidating Hulu is to kind of make this streaming bundle, and so to have Disney Plus, to have Hulu, and then to have a really robust ESPN streaming product, I think is the way that they kind of stay on top in the streaming war. So I'm not really sure they want to necessarily get rid of ESPN, but obviously they do want to have a minority partner there.
Dan Ives was saying the price of $40 billion could get it done, and Apple will do it. Do you buy that?
Yeah, it's going to be really hard. I mean, again, it does come down to the price. I mean, we've kind of valued the business. They generate about $3 billion or so in EBITDA. We think, anywhere from about 22 to 25 billion in terms of valuation. But of course, if they can get the $40 billion valuation, I mean, Bob Iger might really consider it.
Geetha, I got to say, I did some research last night looking at the price increases for all of the different streaming networks, and they've all increased over the past month or two for $2 to $3 a month. And that's just for the basic service, much more for some of the ad-free services. When do people say enough is enough? We're paying 3 times as much as what we paid when we just had a cable bundle, and we can't find anything.
Yeah, that is the big question, Lisa. I mean, we're definitely heading towards a shakeout. You're absolutely right. Every service has kind of raised their prices. I mean, there are two things that are going to happen here. Obviously, everybody wants to have higher ARPU so that they can kind of get to that streaming profitability metric quicker and quicker. And then the other aim is to kind of push more and more people into the ad-based tier. So they're raising prices on their ad-free tier so that, people at some point kind of say, okay, you know what, I'll bite the bullet, I'll take the ads, and I'll start watching. I don't mind watching a few ads if I can pay less. And that's kind of what Netflix's approach has been. That's been Disney's approach. Discovery also did the same thing. So, ultimately their whole aim is to kind of beef up that digital ad business if they can.
Geetha, does finances matter now? And to go to the weighted average cost of capital screen in the Bloomberg, to go Warner Brothers Discovery with 60% debt, these are rough numbers, folks, to Disney's 22% debt, or even Netflix's 9% of debt. What sway right now, what weight do the financial people have in your world?
Debt has been a huge concern, definitely for a lot of these media companies. Of course, for Warner Brothers, the big question, and Paramount is the other name that kind of comes to mind with a huge debt load. The good thing with Warner Brothers is that they're actually using their cash flow to get to that, leverage target. Last year, actually, we had them at over 5 times, I think 5.1 times net debt to EBITDA. They will probably end this year, below 4. They will probably end next year below 3. And that's really what the street is looking at. And I think as long as they're able to keep delivering on that deleveraging tactic, I think, they should be in good shape.
Geetha, thanks for the update. We'll touch base again tomorrow when we get the Disney numbers. Geetha Ranganathan there of Bloomberg Intelligence. Disney, that stock this year is down 2.6%. On course, and I wasn't aware of this, a 3rd consecutive year of losses, Tom.
It's like the bond market. It's like the bond market.
It's not been a great comeback for Bob Iger over at Disney.
You bought this for the grandchildren. I mean, you bought shares. You got them printed out with Mickey and Minnie on them and all that. And it's like the bond market. It's an absolute train wreck.
Well, the Mickey and Minnie part was doing fine, and the cruise liner is really doing great. I've heard that they are really good cruises, and you should definitely try them out. But I do think that there is this arguably question around their expansion of streaming, their lack thereof, the investment in content, and a question of what the future is with that particular.
You pushing cruises on us?
I think that it would be really.
It's a trend. No, we're talking about a surveillance cruise.
Messages I've had about cruises since I was away.
Well, we're talking a surveillance. Look for a surveillance cruise in February. You know, I think
we'll take the cats.
You know,
we'll take the cats.
We'll take the cats.
And the Christmas.
They'll wear their floaties.
They put a tree up on the.
If they can.
I can't imagine anything worse. Can you? A cruise over Christmas? Brutal. Can you imagine?
Cruise over Christmas? Nice.
I cannot imagine.
Depends on where.
It
could be festive, the whole family.
Stuck on a boat with everyone? Absolutely not. Coming up, Peter Chair of Academy Securities. Equities right now just about positive from New York. Good morning.
The Doves can basically say that the labor markets have been rebalanced.
It's clear that there's some softening in the labor market, but there's not a collapse.
There is the high probability of rate cuts next year.
We'd have to see pretty severe deterioration in financial conditions to see rate cuts.
We're going to be discounting the Fed cuts that are coming. That's the bullish case for 2024.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. Bloomberg Surveillance on radio, on television, green on the screen. Futures up now for the first time in an hour. Jonathan Ferro, oil. Moments ago, American oil falls below $76 a barrel. I did not see that coming.
After a 10% move in October as well, Tom, it makes it so difficult to call this market. Things have changed so quickly in just 2 weeks. Jim Kerrin and Morgan Stanley on the program with us yesterday, saying that we've gone from the big bad wolf to Goldilocks in about a week. And the interesting thing about this year, Tom, is that can flip the other way just as quickly. The bulls feel good right now because they believe the doves are in control on the FOMC. Let's see if the data changes that story into year-end.
Lisa knows all the speakers for that, but to me, the basic theme here is follow the data dependency, and the answer is there was a seismic shift. I'll let you decide when. And the thing to me, John, is we're seeing it day after day. I got futures up 3, the VIX 14.74.
To me, I'm just watching to see when this is going to shift, whether we're going to dig in. And I think that the auction that we see at 1 p.m. is going to be really important today to get a sense of that, because a lot of this has hinged on the bond move. The sense that maybe we have stability in a whole number of fronts and we can go back to normal, whatever that means.
But what if we have a normal auction? You clearly believe we're at real risk of something odd. Fine. I'm not a pro on this. If the auction is quote unquote normal, then what?
Then we have a rally. If the auction is normal and you see all of the buyers line up and you see the technicals really show strength in terms of the demand picture, I would guess that this rally has legs, because all of those institutions, like Bob Michael over at JP Morgan Asset Management, who's been saying this is a value buy only when you do see stability and a sign that maybe some of the histrionics of the recent moves have died down.
Peter, share with us in moments here. We're going to really dive into that idea of the 10-year moving lower. John, if you get price up, yield down, I'm sorry, it's just like stocks. They pile on. I don't see the pile on yet.
That move, Tom, over the last couple of months has spooked everybody. On Wall Street, on the FOMC, across the board, and I'd say arguably behind the scenes, maybe even in the White House. It's been a big move higher. Treasury's tried to come out and say it's not about supply. Everyone on this program for the last few months has basically suggested that's an element of the move. The fact that we've come down from 5 to 450 makes people feel a little bit more comfortable. I'd point out this. Still look at the intraday moves. They're still quite large and sometimes on nothing, which is why I do wonder whether we are confusing a rally with stability. It's a rally. Without a doubt, the price speaks for itself. Is it stability? Yeah. And that's what Bramo's looking for a little bit later on this afternoon. If you get that kind of stable auction that we can just walk away from, no news here, the bulls will stand a little taller. We can walk away from this.
Let's do the data, John. The VIX, a regular Standard & Poor's 500 VIX, 14.73 in from 21. And as Dean Kernett said, even more important, I never quoted John, the NASDAQ VIX, 18.45. I guess is a big deal.
Equity's doing better than okay over the last 7 days on the S&P, 8 on the NASDAQ. Futures right now positive by 0.1%. Yields going nowhere. The 10-year 456. One eye on crude all morning. 76 on WTI. The lowest since July on WTI crude. Brent threatening to break 80 this morning, $80 and about 50 cents. Brent crude is negative 1.4%. Lisa mentioned the auctions a few times. Tom, let's go through the numbers again.
Please.
$40 billion of 10-year notes this afternoon. Tomorrow afternoon, $24 billion of the 30-year maturity. So look out for that in the next 24 hours.
10-year real yield, I haven't quoted it yet today, 2.18%, down from 2.50%. It's easier out there to do business this morning. Our guest of the morning to synthesize all this without question, Peter Cheer joins us now, head of macro strategy at Academy Securities. You look for price up, yield down. What will that do to the equity market?
I think for now it's going to be good. I think we see 430 on 10s before we see 475. I think the pain trade is actually to lower yields. A lot of people who were bullish at 5 kind of got short again. I think that works until we get down to about 435. Equities rally on the back of that. Then we realize we're getting there because things like oil, copper are receding because the economy is actually slowing fast. So I think at that point, that's when the recession fears start getting priced back into stocks.
Take an Academy Securities 3-year view. You've got that slowing global demand. Nick Benenbrook on from Wells Fargo, stunning with a 2.4% global GDP call. Can you own equities out with a 3-year vision?
I think you could if you had a 3-year vision. I think right now it's more like a 2 to 3 week vision. Everything's so volatile. We don't know where this economy is turning. We don't know what's going on there. And one thing that's starting to scare me is we're having a lot of discussions about the Middle East. We're starting to hear a little bit more concerns about supply chains. I don't think it's an issue today, but as this drags on, if there's any degree of escalation, supply chains become an issue again. So I think that will be a big drag on the economy.
The Middle East, crude. Last month is just unreal to see a move of almost 11% lower on WTI, even with the heightened tension in the Middle East. A lot of people, Pete, are pointing to maybe demand starting to crack in certain places around the world, Europe, maybe even the United States going into next year. What's your view on that?
Yeah, I think the last time I was here, I said buying oil was not going to be a good hedge for escalation there because oil had been under so much pressure before, and I think that's what we're seeing again. There's just that lack of demand, and the Saudis definitely have the ability to turn on the tap if they want. We're clearly trying to figure out how to work with Venezuela, and so far it looks like Iran's going to continue to pump oil despite the sanctions, despite the heightened tensions there. So there's not much in favor of oil right now, and I think that's a very crowded long position, so I could see that breaking lower.
Going into next year, you mentioned a 2-3 week view. I'm with you. You know what's about to happen, though, in the next 2 to 3 weeks? We're going to get a load of people publishing their outlooks for 2024. Can you help us understand how you get any visibility whatsoever into next year? What's the strategic view going into next year?
I think there's still some big themes. I think AI, how people are using AI, the efficiency that could cause for companies, I think that's going to be a big theme still. So you can look over that. Where are we going to be on the defense spending? Where are we going to be in terms of geopolitical spending? I think the reshoring is still real. I think a reasonably healthy economy with our decent jobs is still the overriding thing. So I think markets are a little bit more volatile right now than the underlying economy is.
So if you put this together to what you said earlier, that you see benchmark 10-year yields getting down to 4.35% before going back up to 4.75%, or just basically they're heading lower. Does that mean that we're going to have slower growth, but still the soft landing, and that it basically people are going to get a little concerned about stocks, but that it sets up a rally? I mean, I'm just trying to understand I think a very convoluted range of thoughts.
So I think as we move towards 435, you get this, this is all good for stocks. And then as you start moving below 440, I think people realize, oh man, we're getting there because things are not good in the economy. The job market has changed. White collar workers aren't doing as well as they were. You're seeing, I think, some potential for spending. You're seeing little cracks in the housing prices. So I think all of a sudden by year end, we're going to be back on a hard landing discussion, and it'll be the boy who cried wolf, but we'll all be back talking about no more soft landing. We've overdone it.
So you think that at that point, treasuries will continue to be havens once again, even though arguably one of the biggest drivers of the yield move has been Washington, D.C., and it doesn't look like that's changing?
That's not changing, but again, that's a 3, 5, 10-year sort of pain. It's, we get ahead of ourselves, and I do think the one problem we all have is the bond market's so big. You talk about these numbers, $250 billion, and it's huge, but it's, a fraction of 25 trillion. So I think the ability to digest this, you see corporate bonds come out 22 billion yesterday, I believe it was. There's no problem digesting this. So I think the market's pretty healthy. I think people see yields as attractive. You're going to see people continue to add to that. So I think that's fine. It's going to be the risk side of things that gets people a little bit more spooked.
Tell me about the November real yield shift we've seen. We've seen the 10-year real yield migrate 2.50% to 2.19%. That makes things easier for everybody, right?
It does, but I think the nominal yields still play a big role. They're still relatively high, and we had that move from 375 to 5, so we haven't clawed a lot of that back. I think there's this long, and variable lag time is really long this time. People did such a good job locking in yields. It's only now that you're hearing more and more people have to roll over their debt, right? If you issue 2-year debt back in the heyday, now it's rolling over. 3-year debt's not quite rolling over. So I think we're just starting to see that slowdown impact. And I think one point John brings up, we've got what we've been calling this faux liquidity, this fake liquidity. It feels like the markets are super liquid at any given price point, but the ability to gap high or low is there. So I think we got pushed to 5% by people getting stopped out, pushing on yields. We're now got back to 450 in a heartbeat because people are getting stopped out the other way. So that's what we're trying to, I think, manage is like, what's the real noise versus the signal?
You mentioned the great financing of the pandemic, the huge wealth transfer we had from Treasury to the consumer. Consumer balance sheets were stronger. Everyone under the sun who owned a house, remortgaged, termed out that debt, low rates. Corporate America did the same thing. One place didn't. Treasury. Stan Druckenmiller has been very critical of leadership at Treasury over the last, 5 years through that low interest rate period, not terming out the debt. What are your thoughts on that? What do you think about that conversation?
Yeah, I think they should have done what corporations did. I'm always a big believer, right? Borrow long, it locks in, you reduce volatility. And we're having a lot of conversations with clients, probably a little bit hypothetical at this point, but maybe people are supposed to be underweight treasuries and T-bills and way overweight, whether it's commercial paper or corporations, that, right, if you take a step back and talk about this as being governance, right? The U.S. governance is awful right now in terms of our spending, in terms of we talk about not paying our bills, right? You look at the large corporations of the world, they have good corporate governance, they have global plans. They never once would ever even think about saying, oh, we're not going to pay our debt on time because we don't feel like it. So I think you're supposed to be starting to push really heavily to overweight high quality corporates, maybe in commercial paper, maybe some ABS, and move really underweight T-bills.
So do you foresee a time when Apple can borrow at a lower rate than the U.S. government?
That ability to break the sovereign ceiling rarely happens even in emerging markets. I don't think it happens here, but I do think you can see really tight spread compression, especially at the front end of the corporate bond curve. So I like that as a trade.
You think we get convergence, spread compression on governance issues alone?
I think that will play a part of it. Yeah, I think the top quality companies have a ton of cash. The liquidity in the bond market's not what it once was. So whatever you have to pay up to own T-bills, maybe you don't. And I think this government issue is going to become a real thought. Again, if you think about it, why would you lend to someone who talks about not paying your debt?
Because for a long time, they've had the privilege of acting recklessly.
Correct.
We've talked about this so many times. There's been no consequence for it. Why is this time different?
I think something we talked about before snapped in the market. And all of a sudden, people are really questioning this whole, correlation or coalescence of events that have been on the back of everyone's mind. I don't think it cracks this time, certainly, but I think it starts setting us on stage. Again, I always go back to the great financial crisis. It started breaking in 2006, got fixed, broke again in 2007, got fixed, broke again in 2007, got fixed. So I feel now we've started this unwind, and unless DC gets its act together, this is going to be, every time it rears its head, it'll get uglier, but it's not this year's story anymore.
Pete, love it. Always thoughtful. Peter Cheer there of Academy Securities. If you are just joining us, welcome. Your equity market's still just about positive on the S&P 500, up here by 0.05%. Bramo has thoughts. You know when Lisa has thoughts, don't you?
It's
that lean. It's at the corner of my eye.
Bramo,
I'm just looking at the price action, and it's at the corner of my eye. It's the Lisa lean. It's like, I've got thoughts on that convergence.
I'm thinking about it, and I'm thinking about when will it crack? When will the privilege of acting recklessly sort of run out? Okay. And there's this question to me of a sort of malicious spiral that if borrowing costs are higher, just globally, if rates are higher, that actually pushes on a string that much more, because that means that interest payments are actually going to be a significant proportion of the annual GDP of this country. That's when things start to change a little bit.
I'm going to listen to nitty-gritty experts. Robert Schiffman is a jewel at Bloomberg Intelligence on credit. He just published Amazon could issue $20 billion more debt but doesn't need to. That's the heart of the matter in this odd time we live in.
That marries both of your views. I mean, you think they can, ultimately they can. Lisa's saying they don't need to because they don't need to.
I'm going to go Zvi Bodie up at Boston University and say you want to have a balance out there. And at some point, like you said with the CFO of Apple, they'll be opportunistic at what they choose to be the right time.
Michael Dada of Roth MKM joining us shortly. Look out for that conversation. We'll catch up with him in about 20 minutes' time. Up next, Libby Cantrell of PIMCO on the situation in the nation's capital. Live from New York City this morning. Good morning.
Playing politics with IRS funding is unacceptable. Cutting it would be damaging and irresponsible. The IRS collects 96% of the federal government's revenue, and this is the funding that enables our country to protect national security, provide Social Security and health care, and invest in our nation's infrastructure.
Treasury Secretary Janet Yellen there speaking in Washington at an event to commemorate improvements in the IRS. Secretary Yellen there. More on that in just a moment. Equities right now on the S&P 500 totally unchanged. Yields going nowhere. 456.66 on a 10-year. We've talked about all that supply coming up later and tomorrow. In the FX market, the euro a little weaker, dollar stronger against most of G10 through most of this morning, 106.70 all morning. One eye on crude, $76 on WTI, down by about 1.5% today. For Brent crude threatening to break below $80 and back into the 70s, $80 and about 40 cents at the moment, Tom. Lower by 1.4%.
Yes, that didn't float in the last 20 minutes, but moments ago, like 30 minutes ago, we had green on the screen across SPX, Dow, and NASDAQ 100 is, well, VIX is constructive. I mean, there's some very subtle things here. And, John, again, I'm going to go to the way you opened the show where you said, 6, 8, 7, 8 days in a row of equity joy. It's the quality and character of that equity joy. And like oil, it's just this persistent shift.
On the equity market, inspired by the bond market move, are we still at the whim of what happens in fixed income? What Peter Chi said of Academy about 10 minutes ago, I think is really important. We look at the move in yields and we take comfort from going from 5, he's looking to 430. And then ultimately he thinks that when you get to 430, you start to think about why yields are lower. And perhaps just yields being lower is insufficient to inspire an equity leg up from here, Tom, and ultimately you have to start thinking about why. And as you get closer to 4, in Pete's mind, you're thinking more about a slowdown in the economy, which becomes arguably less supportive for what happens in stocks.
Totally agree, and the way it feeds in is at the revenue line. If you get lower nominal GDP, this stagnant disinflation I'm talking about, if you get stagnant disinflation, revenue growth doesn't happen away from a magnificent 7 that have their own revenue.
All these words on this program, stagnant disinflation, what was your word
I'm just
this morning?
trying to keep up.
Devolatilization,
Let's
which
go to
we've been told is a word.
devolatilization right
It's
now.
a word.
Amy, bring it up right now. We've got this.
Okay, it's a
This
word.
is from Morrison and Boyd Organic Chemistry from a few years ago. Devolatilization. Thanks to our listeners, this is from a guy over at methyl, ethyl, and ketone. Devolatilization process involves the emission of volatile gaseous matters, which are ignited and undergoes a humongous combustion after heated up to a certain temperature.
See? That's what Lisa meant.
That's
exactly
what I
meant. That's exactly what Lisa meant when she looked at stocks totally unchanged this morning. Tom.
That's good. Thank you for that from methyl, ethyl, and ketone. Really appreciate your research department. Libby Cantrell joins now. Managing Director, Head of Public Policy at PIMCO. Libby, you're the only one I can do this with. Can you take the election results and you can fold them into a government shutdown, which happens in about 3 cups of coffee? Can you make that exercise happen?
Yeah, well, good morning, and thank you for not asking me a question about Orgo. I did not take organic chemistry at school, so thanks for not testing me on that. Yeah, so I do think that the read-through actually from last night, Tom. So thanks for a layup here. Is actually Democrats won a special election in Rhode Island. This was a blue race, a blue seat. This is a House seat. That means that they have 213 seats in the House. Republicans, however, only have 221. They have a special election in Utah in a few weeks. The reason why this actually means this is important from a government shutdown perspective is that means practically that Republicans now can only lose 3 seats 3 votes in order to pass a funding bill that they need to pass to avoid a shutdown by next Friday. So it just means that the margin of error is much more narrow for Republicans. Speaker Johnson was already needing to thread a needle, if you will, and that needle point has just gotten even more narrow from the results from last night.
In threading the needle, what will moderate Republicans do? I don't have it in front of me, but I'm going to suggest on Long Island, east of New York City, the Republicans had a good night. What are the moderate, I guess the former president would say, Republicans in name only? How do they adapt and adjust off this election?
Yeah, well, I think that what we learned last night is that the abortion rights still very much resonate. That was obviously a takeaway from the 2022 midterms, where abortion really emboldened turnout. It shows last night that this really is very much an issue, especially when it is on the ballot. Now, I think for 2024, many of these folks, particularly in those districts, Tom, that you mentioned, where there are Republicans who are defending Biden districts, the Democrats will make this an issue. You're going to hear a lot about abortion rights over the next year because of the results of last night, just sort of underscoring that this clearly is a resonant voting issue for voters. Now, in terms of the government shutdown, what does that make those moderate Republicans do? They are voting in lockstep here. They really are trying to give Speaker Johnson the benefit of the doubt. I think that will continue. I think the big question for markets is that enough? Can they actually avoid a shutdown? If they pass a partisan bill, Tom, we will see a shutdown next Friday. So again, kind of an open question of how this all resolves. But as of now, it looks like they are voting in a partisan way, which means that shutdown risk is increased over the last week or so.
Do markets care, though? I mean, is a shutdown basically, okay, they're going to do it for 24 hours for effect, and then we'll move on?
Yeah, Lisa, I think that's the real issue. If it is a temporary shutdown, no, this will just be more DC noise. If it's a longer, more prolonged shutdown, it does become, the economic impacts of lots of federal workers being furloughed, not actually collecting a paycheck, could matter. And also, the data matters, right? If we don't get data from the Department of Labor, for instance, that makes the Fed's job, a little bit harder. And we can also see, that this term premium that you all have been talking about, we could see, some of the yields back up again as well on account of this. So I think you're right. If it's a short-term shutdown, no, the markets probably don't care. If it's longer term, however, it may weigh on, again, on just sort of the confidence around sort of the political apparatus in Washington, D.C.
Just shifting from last night's elections to what we're expecting next year in the presidential election, how much of a certainty do you think that it is that we're going to see President Biden versus former President Trump? How much will tonight's debate really color that discussion about potential other running candidates for the Republican Party in particular?
Yeah, so I think what we've been messaging to clients, Lisa, is with high conviction, President Biden will be the nominee for the Democratic Party. This idea that he is going to drop out, that Governor Newsom, for instance, may jump into the race, it just is not. It's just not realistic at this point, nor is there any indication from the Biden camp that he has any interest in dropping out or any intention of dropping out. So he will be the Democratic nominee, again, excluding or assuming there's no sort of exigent health issue or what have you. On the Republican side, President Trump obviously has an incredibly formidable lead in the polls, but this is actually a really important point. His campaign is much more organized, I think, by his own admission, than it was in 2016. And they have been systematically changing the delegate rules in the states in terms of how the state primaries allocate delegates to his benefit. So not only does he have this formidable lead in the polls, but he's also sort of changed the machinations behind the scenes in terms of how these delegates are allocated. And of course, getting the nominations just a delegate game. So the fact that he's been changing these rules is to his benefit as well. So, a lot would have to happen, I think, tonight and over the next 2 months. Now, I think what we can show from even last night, that voting behavior is the most important thing to look at, and polls are not always right. And so particularly in Iowa and New Hampshire, Nevada and South Carolina, those are the 4 first contests, Lisa, and how we're guiding our clients is if Trump wins all of those, then he very likely is going to be the nominee. However, if there's somebody contests one of those, then it could be easily become a two-person race. But again, sort of remains to be seen. In terms of tonight, it's really a race for number 2. DeSantis and Haley. I think we'll see it be pretty nasty and pretty ugly tonight.
I'm looking forward to that debate a little bit later. Libby, thank you. Good to catch up. You're one of the best. Libby Cantrell there of PIMCO.
The auctions at 1 p.m.
Nasty.
Steal up nasty.
Tomorrow.
And then steal up for the debate.
Is that an actual call or a bit of snark?
Great. I don't know.
Okay.
What
all
do
right.
you think?
No idea. Up next on Bloomberg TV in the next hour, Kelsey Barrow, JP Morgan, Darryl Crong, Wells Fargo, Jay Pawlowski, TPW, all of that going into the opening bell from New York. This is Bloomberg.
Bloomberg surveillance, Bramo, waiting for the auctions. I'm waiting for the auctions, too. Tom Keene and Lisa Abramowicz, John Ferro in deep preparation. Jay Pawlowski in the 9 o'clock hour.
Yeah.
Important conversation.
Curious to hear what he has to say about China in particular.
I was thinking Duke football, but, we'll have to see. Anyways, we're here, and we're coming up on 8:30, except there's no data at 8:30.
There's no data at all this week. I mean, it's a really quiet week after last week's discussion. So if it's quiet, someone's got to fill the noise. It's all the Fed speakers.
The Fed speakers will be there. That's our theme right now. Michael Darter with us. We'll get to him in a moment. But briefing us and getting us to move forward through the week of Fed speakers is Michael McKee. Yeoman's duty last week. He had 3-day marathon, if you will, off the New York Marathon last week. And it's a quiet. What do you do in a quiet week? What do you do? Do you come in slip in at 9 o'clock?
I wish. I come in and I read research and I look at charts and I listen to Fed speeches.
What's the confidence of the Fed right now among the research that you read? Do they believe in this Fed?
It depends. It's pretty much split. There are the people who think the Fed are complete idiots, and there are people who think the Fed is only slightly stupid. If you're on Wall Street, that's the game, is to say the Fed is wrong about something, pick something. The general view, though, is that the Fed is going to have to cut rates sometime next year, which the Fed had already predicted in its dot plot and SEP in September. It's only a question of when and by how much, and still a question of why. Is it recession? We've got some people, Connor Sen on Bloomberg today, writing it's time to start worrying about recession. And then we've got people thinking it's, you're going to see inflation go down, so real rates go up, and the Fed will have to loosen to keep from tightening too much.
Here's what I'm struggling with. At a certain point, the Fed officials have just come out and said, we don't know. We're looking at the data because we're not sure exactly whether we're heading toward recession or whether we're heading toward a reacceleration of inflation. So given that, people are kind of ignoring what they have to say with respect to exactly whether yields are too high or where the balance of risks are. What are you listening to, especially with the big three all speaking today and tomorrow in the Federal Reserve, to understand what could shift their view of whether they have some sort of inkling of whether the balance of risks has truly changed?
It's going to take more than just a couple speeches, and I'm not expecting anything this week. I think we basically get a lot of sound and fury signifying nothing. As Neil Kashkari told us yesterday, we've got weeks to go. There's 6 weeks before the next Fed meeting and a lot of data. But what everybody would find the most useful is what data and how much of it do they need to see in order to decide what their next moves are going to be. And that's kind of an open question because the data are always backward looking and they're looking for guidance on what might happen. So they're looking at forwards, they're looking at futures, and they're looking at expectations at the same time that they're looking at the data that comes in, and they want to put it all together and figure out where's inflation going.
They're also watching the 10-year auction today at 1 p.m. where you've got $40 billion being sold. And I say this because Chris Waller, Fed governor, yesterday came out, and John was referencing this earlier, and saying the jump in 10-year yields was an earthquake. We heard this also from Neil Kashkari yesterday when he was speaking with us. He is not clear on exactly why yields have gone up as much as they have and then come down. How much is this a concern to the Fed, that this is truly a sign of market dysfunction?
Oh, it's not a sign of market dysfunction, I don't think. And I don't think the Fed thinks it's a sign of market dysfunction. I think the problem has been that this is an unusual period, and the Fed is trying to figure out where to go with interest rates. They knew they had to raise interest rates a lot, but the market kept pricing in cuts. And then they finally decided to believe the Fed, and we saw rates go way up. Now, there were also hedge funds piling in leverage on short bet on treasuries because of this. And so you get this outsized move that is an earthquake for bond traders, and if sustained, changes the game a little bit for the Fed, but it's not a sign that things are not working.
I said earlier it's Michael Barr Wednesday. To me, Michael Barr is by far and away the most important Fed speaker. He's much more in the financial bank supervision
that's his
side.
job, yeah.
What message does he want to convey to a beleaguered commercial banking system?
Oh, I think they would argue, they would push against the idea that the banking system is beleaguered at this point. But what they're looking at now is a series of regulatory changes, one to the Community Reinvestment Act, and two to essentially Dodd-Frank and the Basel regulations. And those take about a year to implement. They have to put them out for comment and stuff. So he's out explaining what they're doing and what they're trying to do and trying to win support for that. Interesting discussion came up overnight about whether we should see the non-bank sector. The CFPB is talking about putting more regulations in place for the shadow banking system. And that's going to be an issue going forward. When you talk to Fed officials, the one constant they say is that we don't have enough window into what is going on in the shadow system. Therefore, we could have a problem there and we wouldn't know it.
Michael McKee, thank you so much. Lisa, I'm afraid to ask, how many Fed speakers tomorrow?
Well, we had the big ones, right? And we have at that IMF panel, as you were mentioning, we do hear from Fed Chair Jay Powell in a more comprehensive, moderated speech.
Saving us, Michael Darda here with Careful Conversation, Chief Economist, Macro Strategist, Roth MKM. Michael, you know where I'm going. I need a calculation of the two moving parts of the Darda nominal GDP. I got a real economy gyrating around, and I got some form of disinflation gyrating it down. Define the Darda nominal GDP into 2024.
Thanks for having me on, Tom and Lisa. Look, Tom, I don't think anybody's talked about this morning yet, but there's actually a metric in the monthly job statistics called average weekly payrolls. It's a really clumsy title for basically the sum of wage growth, job growth, and hours worked growth. And that is really close proxy for nominal GDP. So real growth plus inflation, total spending in the economy. That printed 0 in October. Not only that, you have the unemployment rate that's moved up to 3.9%. From a cycle low of 3.4% seen in April and in January. Over a 9-month interval, we've never had a 0.5% move up in the unemployment rate that was not associated with a business cycle peak or an economy already in recession. So essentially the proxy for nominal flat lines in the unemployment rate at least is giving us, I'd say, a soft recession signal. And I think that can tell us a lot about why the bond market is rallying here.
Michael, that's the first chart I looked at this morning, folks. This idea of how low did the unemployment rate go, and as Mr. Darda mentions, up we go to near 4%. I would suggest that we've got a new regime, sort of as we look at a new regime of our starter where the Fed's going to land on monetary policy. Do we have a new regime in pure U3 unemployment rate? Is, for example, 4.3% the new 5% unemployment?
Well, it would be unprecedented in the sense that anytime you go up 0.5 percentage point, you continue to rise, with a cumulative rise during a recession of at least 220 basis points. Usually it's a little bit more than 300 basis points in total. So if we end up with a situation where the unemployment rate just goes a little bit above 4 and stops, that's possible, but it's literally unprecedented. So typically when you start to see the unemployment rate hook upwards, it continues for a while. It signals a recession that isn't recognized right away. And if the neutral interest rate, R-star, starts to fall here because the economy is rapidly losing steam and the Fed is reluctant to follow suit, that's how you end up in a recession, hard landing. And I think that would end up reinforcing the message that the yield curve has been sending now for well over a year, a long leading indicator along with monetary growth, along with the tightening in lending standards. We got another iteration of that yesterday out of the Fed Senior Loan Officer Survey. So all of the leading indicators have been suggesting that we're getting long in the tooth here in terms of the business cycle, and that recession risk is still elevated, even though the consensus view on Wall Street now is that the soft landing's in the bag. It always looks like a soft landing just before a recession. Trend growth is an oasis to below trend growth, and below trend growth means the unemployment rate is going up and you have a recession.
That said, a lot of people would point to recent earnings and say there are so many companies that are beating expectations, that are raising prices and increasing volumes. Think about more expensive Macs and all sorts of burgers and Starbucks drinks. How do you push back against that, the corporate America story that has been told in earnings?
Yeah, no doubt about it. Good point. So there was a fear that earnings would just crash this year, and that obviously has not happened. But if we look at forward-looking earnings, the 12-month forward estimates, they've essentially gone nowhere since the summer of last year, yet the equity market multiple is up 3 points. And bond yields, even after this rally in bonds and the drop in yields from the highs of the year, are well above where they were mid-year last year. So the equity market has become more expensive in absolute terms and more expensive relative to fixed income. So I think we have, high hopes here that the business cycle is going to be sustained, and eventually, we go back into a upward profit cycle. And I think those hopes are going to end up being dashed.
How much do your clients push back against you, saying everyone was worried about recession 1 month, 2 months, 3 months into 2023 and just kept being wrong? And so why is this time different when you do look at all this strength out there?
Yeah, it's interesting. I think there's quite a bit of confusion out there in terms of the money management community. I mean, certainly some folks have been, quite bullish, and it's been, a good year if you're bullish on equities, if you're just looking at the broad indices. But it's been a very narrow move upward in the S&P 500. We really haven't done much in terms of an equal weighted index. And obviously, you guys have been talking about the small caps underperforming, and some of the, the groups that are tied closely to the economy and cyclical value really struggling. So I think it's more confusion out there than like tremendous conviction. And look, forecasting's a tough business. When the yield curve went into inversion, we started to get a lot of leading indicator weakness. Our view was if you just go with the historical parameters, you would look for a recession sort of mid-year into the fall. And, certainly that looked wrong when you had this huge GDP print in Q3 and this rip-roaring equity market rally in the S&P, even though it was narrow this year. But yet, as I mentioned earlier in the segment, we could be on the cusp of a business cycle peak here. So, we haven't really written the entire story just yet. So we'll see how it unfolds from here. But there's certainly room for debate. There always is.
Michael Darda, thank you so much. With Roth MKM. Green on the screen, futures up 3. They sort of stayed there all day. NASDAQ floating around a little bit of red with the NASDAQ. On the S&P 500, we're up 0.2%.
There's a story that caught my eye. We've been talking about the strength in the labor market, Tom. This is the latest. American Airlines is looking to offer $250,000 bonuses to pilots from FedEx and UPS who ditch those employees and employers and go to American Airlines.
A number of people, including Helene Becker, have been way out front on this story. I have trouble with it when I'm on a smaller plane and the kids getting on. I'm like, can they drink at a bar? You
don't think that the pilot is old enough to do anything?
Building.
Got it. Well, this has been the issue, is that how do you get these people in? And if you don't have them, it becomes a real revenue drag, considering that you have to ground planes and cancel certain flights. And so you're seeing these incredible bonuses being offered.
Yeah. I think every industry is different, and I think the amalgam of, as Mr. Darda talked about, is we're still at a very low unemployment rate. I'm not sure I know what a high unemployment rate looks like anymore.
I don't think anybody does. I think that's a really good point, especially given that it does tend to be asymmetric on the way up. But to what? And that actually matters quite a bit.
To what is to the auctions this afternoon. Stability on the tape right now. West Texas Intermediate 76.68 after printing is 65. We have the Bramall countdown clock, and we're a solid 4, 5, 6 hours, whatever it is, from the auction. What actually happens at 1 or 2 p.m.?
Well, at 1 p.m.,
there's like a press release?
Yes, and they release the results, and then there's the trade immediately after the bonds are issued to the primary dealers, to the direct bidders, to the indirect bidders, and then they put out all the technicals to understand exactly what happened.
Stay with Bloomberg Surveillance, 1 p.m. this afternoon. Our special report, The Treasury Decides.
Okay, stop.
Good morning.
When I take a step back and look at the inflation readings more broadly, it still looks like we're trending toward 3% as opposed to 2%. We thought growth would start to slow before and been surprised by the overall resilience. So I think that we're going to continue to need to see tight financial conditions in order to bring inflation to 2%.
Lori Logan, Dallas Fed president, are saying what a lot of Fed officials have been saying recently, which is they have all been surprised by the strength of the U.S. economy. Welcome back. This is Bloomberg Surveillance. John's off preparing for the 9. Tom Keene, Lisa Abramowicz. Tom, I think it's just amazing to see the sort of overlay of gloom, as you put it, on top of earnings that have actually been pretty decent.
The earnings have been pretty, I'll go with that. But I think in what we're going to talk about here in commercial real estate is just flat out gloom. And what I'm doing, folks, and I don't know about the rest of you across this nation, but I'm reading every single real estate transaction article I can. People love to talk about this, but the fact is they're coming fast and furious right now, and that adds to maybe a templated gloom.
I'm looking forward to the conversation. Just quickly to give you a sense, not just of headline where the index levels are, but some of the names moving beneath the surface. Warner Brothers, we were talking about this earlier, how they came out and they did disappoint in terms of a third quarter loss that was bigger than expected. Free cash flow is still stronger than the expectations, yet still those shares getting absolutely hammered, down almost 10% ahead of what we're expected to get after the bell with Disney.
I didn't see that. And that 10 level on Warner Brothers is key. I mean, if I just do a quick chart here, I'm down to $9.53 as a low. So that's really coming back. I'm going to call that a huge disappointment.
And there's this real question around how much stocks are getting punished for missing much more this cycle than in previous ones. New York Times shares are up because they did report a better subscriber growth than expected. This is something to watch. New York Times up about 6%, 5.74%. But I wonder how much you start to see consumers coalesce around the idea of actually paying for subscriptions, especially for the cooking and the Wirecutter and the other types of services from the likes of the New York Times. And Roblox popping more than 16% after reporting bookings that beat estimates. And to me, I thought that was really interesting just because everybody left this company just a few months ago for saying maybe it was just a blip during the pandemic. And now it looks like maybe not so much.
I would just have to see. I think it's story by story, and what I see is a resilient bid. I mean, I would think within the swirl this morning that we'd have futures down, a nice amount, and this is day after day now. They're just not. There's no other way to put it.
And it's the longest streak of gains on the S&P going back 2 years. We have been talking about WeWork and the potential ramifications for commercial real estate around the world, but particularly in the New York and San Francisco markets. Joining us to talk about just how bad of a time this is for this to hit, Alexander Goldfarb, Senior Research Analyst at Piper Sandler. I want to start there, Alexander. There have been discussions around the number of leases that WeWork is going to abandon. Is the pressure on commercial real estate, office space in particular in New York, is it overstated right now or understated?
Well, good morning, Lisa and Tom, and thank you for having me on. Here at Piper Sandler, when we look at what is going on in office, it's eerily similar to what happened with malls, over the past decade. If you recall, everyone pre-pandemic thought every single mall was going to close because everyone was going to shop online. And in fact, what happened is the dominant malls like the Roosevelt Fields or Houston Gallerias continue to excel and lesser malls fall away. The same thing is with office. So if you look at WeWork, which we don't cover WeWork, but if you look at some of the fallout out in San Francisco, they rejected a bunch of leases. They did not reject one lease from Boston Properties. When you look in San Francisco, when you look in New York, companies like SL Green, Vornado have zero exposure now to WeWork because they exited those WeWork leases over the past number of years. And even Boston Properties only has 1%. So when you look at the fallout that's going to happen and you look at the major REITs, and especially the ones that we cover here at Piper Sandler, the impact is negligible. And what's really interesting is when you look at office, especially here in New York, it's gravitating around Grand Central. And actually, you're seeing rents increase on Park Avenue. So just like malls, the dominant office will survive. The lesser, the generic office, that's where the trouble is.
So are you saying right now that the prices have baked in a lot of that trouble, or that people just haven't been discerning enough to understand the winners versus the losers?
Absolutely. If you speak to the brokerage community like Newmark, they and Cushman and the other brokerage companies are starting to discern the difference between top tier versus generic Class A, Class B, et cetera. So when you look at what tenants want today, tenants want, great space with a lot of amenities, convenient for commuters, and they want a landlord who has the capital wherewithal to invest in the properties. And let's face it, the brokers want to get paid a commission. And you're seeing that fallout. It's no different than we've seen in retail. So again, I use the mall example. Simon Property Group, with their $1 billion a year of free cash flow, tenants know that they can be there. The same is happening in REITs with companies like SL Green.
It's right where I wanted to go. Alexander, you're reading my mind. What is David Simon going to do with this? Folks, Simon Property Group, Indianapolis, 3,000 employees. What is the guy from Indiana University can do? He's seen this before. We come down, but my history is fresh money always comes in. When does the fresh money click in if transaction to transaction I'm down 40%?
Well, you are speaking David's mind. He loves cash flow. So since IPO, the company has paid out $39 billion in dividends. And the reason they've done that is by investing shrewdly. So when you look right now, he's very focused on investing in his malls. So apart from the Taubman acquisition, which was structured before the pandemic, he hasn't bought anything on the outside. His focus has been investing in the malls, like out in Northgate in Seattle, where they're converting it into a hockey arena, or Houston Galleria, where they're adding office and apartments, et cetera. So that's where he's focused. But let's face it, given the challenges away from Simon, he can pick and choose. But if you look, he's making a ton of money out of his portfolio, which people forget is actually small. It's only 120 malls and only 200 or so domestic properties in total. So he's a large company, but with a small powerhouse portfolio.
Right. But Alexander, I got to make some headlines here. We're in the business of news. Alexander, there's blood on the streets. We see it in New York, and I get it. New York's its own little weird place, but there's all across the nation real estate blood on the streets. Are you saying in your world of REITs, back to when you were at Lehman, your world of REITs, is it now a screaming buy because of all the agony Lisa was just framing?
So it's not a screaming buy in the sense that interest rates are high, right? We have a 10-year that was approaching 5%. It's now backed off a little. But certainly the financing market, which, as you guys have reported, is basically shut down, right? CMBS market is tough. You walk into a bank and try to get a construction loan, they'll call the cops on you. They're like, we don't do that right now, right? So lending is very tough. The transaction market is almost on ice because of the widespread. What's interesting and people miss, and Tom, you're like my first boss at Lehman, David Schulman. You've been around a number of decades. Real estate right now is benefiting from a phenomena that it has not had in a long, long time, which is low supply, because nothing new is getting built, and low vacancy. That combination is really powerful. And you started the show by saying, how is the credit going to get worked out? Again, as we've spoken before, back in the GFC, everyone was panicked about the CMBS. No one can tell you where the benchmark GG10, what happened to that famous 2007 deal, right? Stuff gets worked out. Obviously, there will be pain. There will be blood for sure. But if you look at real estate's biggest benefit right now, it's that lack of supply and low vacancy. Right. That's a huge positive that is underappreciated by the market.
Just about 30 seconds. What happens if there's forced selling, akin to WeWork?
So WeWork is a tenant, so you don't really have forced selling from that. But to be clear, banks, where everyone's focused on, they're not in the business of running real estate, right? So as long as it's a good asset with a good sponsor, they're going to work out some deal, because as the old adage goes, a rolling loan collects no loss. That said, there's clearly going to be assets that will go back to the lenders. Right. And those are the assets where the economics don't exist. That's the stuff to worry about. But the big properties like the 399 Parks, the One Vanderbilts, those big centers are going to be fine. And again, when you look at where the value in real estate is, it's accruing at the top. Okay. But you're right. There will be blood, and the blood is going to be from generic assets.
Alexander, brilliant. Alexander Goldfarb, years of work at Piper Sandler now on real estate investment trusts. I took notes on that. That was
fascinating. Where it's been priced in and where it hasn't is interesting.
It is an extraordinary day. West Texas Intermediate, $77 a barrel. Please stay with us on radio, on television. Bloomberg Surveillance